Ladies and gentlemen, welcome to the Midday Market Monitor. Finally, after one whole day of being red, we're back to having a green day in the markets. S&P back above 7,700, up 0.35%, and the NASDAQ up 0.24%. As for the Mag 7 names, Tesla is leading the charge, up 3.1%. Amazon up 1.8%, back above 264. Meta seeing a green day after some of the trial scares that we ended up seeing yesterday. Nothing resolved there. It's just, maybe we went a little overboard in the sell-off. Curious to know your guys' thoughts about that. Obviously, some people are believing that this is going to be a massive, massive cost to Meta. Other people thinking that this is a drop in the bucket versus their earnings that they're expected over the next 10 years. Now, Apple also above 315, up 1.6%. Really big day for Apple there. Microsoft up 0.6% and Google up 0.1%. The only red name in the entire Mag 7, Nvidia, sadly. 219 on Nvidia. Nothing to complain about there. But the big stories of the day lie in Moderna. Moderna passed phase or entered phase 3 of trials for a cancer solution for melanoma, if I'm correct. That was in relation with Merck as well, so they're seeing some excitement there. But OpenAI disaster. Hello, everyone. I mean, it's less of a disaster than I think people are giving it credit for. And you can see that in the stock market today. I think some people thought that this was going to really create ripples through the stock market, but we're really not seeing that. Honestly, in a lot of the AI names, things are remaining pretty, okay. Marvell is up 8.9%. That's actually on the back of a new chip deal that they ended up signing. IREN up 2.2%. SK Hynix up 2.2% on a $29 billion buyback program. And then some other names like Nebius is down 8.4%. Lumentum down 4%. Some of those names are taking big hits. Let's go ahead and quickly check the stock draft, see where the positions lie. I'm still in the lead at 8%, but fallen a little bit since the 11 point something percent that we were at before. And those are the full lists. Man, Jason's taking a hit, down 18%. Chris, I thought Chris had Moderna. Wasn't there a conversation about someone picking Moderna? I forget. Or maybe that was Steve. He put in the wrong ticker or something. That would have been crazy if someone's position just went up 120%. Steve's up 4%. Matt's up nearly 4% as well. Amit's down 15.8%. Let's see what's happening with Chris's portfolio. Like, honestly, what's going on here? Not a single red name. The best position is down 7.2%. I mean, that has got to be... he's in a position where I don't know if you can come back from this. He can pick some new names. Some things can obviously turn back around. But that's, hard to come back from. I wouldn't write off Chris. Chris has a good portfolio. I like his portfolio. Fluence, obviously, is what's really holding back his positions. But the fact that he has names that are up 63% is quite insane. And then Amit, obviously, I really like his portfolio. A lot of them are down right now, but they can come back very quickly. If you have a portfolio that's made up of Google and Reddit and AMD and Texas Instruments and SanDisk and Rocket Lab, Galaxy, Bloom Energy, these are extremely high beta names that can move markets. Yeah. Let's see here. So that's looking all right. What's holding me back? I'm curious. Sometimes I forget what I have in this portfolio. QXO and Vertiv. Yeah, Vertiv didn't have the greatest earnings. So that I truly am worried about. QXO is obviously a rate decision play. And once Lumentum ends up turning positive, which I think it will, and Coinbase and Robinhood will end up benefiting from a little bit of a crypto rally that we're seeing. I freaking love the portfolio that I currently have. And SMCI, if they can continue to prove out the guidance that they just guided for the full year of 2026, I'll be very happy. All right. Rubrik was a great pick. Yeah, I really like that name. Okay. Let's go ahead and take a look at some of the stories that we've had throughout last night and this morning. Part of the reason why Nebius is down is doing a convertible note offering. So this is bringing their stock down. This $4.5 billion raise. Really, really big raise comparatively to the $750 million senior notes that they've had previously. Now, these are convertible, so it's most likely going to hit equity and not just purely interest payments. So this is keeping their payments down today for a response of shares into the future. Now, obviously, that this is what is going to happen. Everyone said that they really liked Nebius because of their lack of debt and lack of raising versus CoreWeave. And I've been adamant for a long time that I said that CoreWeave is just much older than Nebius. Nebius is going to have to follow in the same respect in terms of the amount of money that they're going to raise, because what brings in the revenue and what is end up, your contractual obligation to fulfill, the tranches of Microsoft and Meta and all the future other contract, like other deals that you want to end up bringing on, is you need active power. In order to get active power, you need to set up contracts. You need to get, customers building up those data centers. You need GPUs. You need a lot of money in order for you to do that. So this is actually why Nvidia remains the largest position in my portfolio. Is at the end of the day, companies are rushing to take on debt. They're rushing to sign out these deals and beat their competitors. And there's like this, big race to see who can set up the best models, most amount of active power, all of this. And that's costing them a lot of money. Well, the beneficiary on the other side of that is essentially a, hardware developer, even though they don't even develop the hardware. They're just essentially creating the files and then sending them to TSMC, which is not CapEx intensive. They're just really smart at doing so. So Nvidia feels like the perfect company in the mix of least amount of risk to take on, most upside. And I know a lot of people are worried about them setting up data center deals that is essentially them backstopping or financing those deals, but people make it out to be like it's the same unit economics, but with more risk. And that's not what's happening. That's a really important point that people should touch on more, is how much Nvidia used to make on a gigabit data center and how much they are going to make now that they're financing it. And there's a couple different S curves that are happening at the same time. So one is the amount of gigawatt data centers that are actually coming up at the same time. That has been a massive S curve, like huge growth trajectory, and increasingly so. That alone is a very positive story for Nvidia and AMD. The next story that's happening on top of that is the per chip basis, per gigawatt. The cost of a gigawatt data center is essentially doubling. We're going from 50 billion a gigawatt to somewhere around 80 to 100 billion, as said by Jensen Huang, right? Cost of the chips are practically doubling. So that's a bullish growth trajectory that's happening on top of the amount. So instead of just going up this much, or the cost of the data centers going up, they couple on top of each other to, reach higher highs. On top of that, you have this financing that's also happening, which does, introduce risk into Nvidia's playbook. But it also means that potentially, if we look back at, previous costs for a gigawatt data center, $50 billion, roughly about 35 billion of which goes to the chips and networking. And that can get a little bit higher depending on, how much of the networking that Nvidia actually takes over. But like for a CoreWeave data center, you're looking at like 35 billion. Okay. If they start financing that as well, over the lifetime of the deal, you could potentially be looking at profitability per gigawatt data center instead of it being 35 to being closer to like 45 or $55 billion just to finance those chips. Now, it didn't cost Nvidia $35 billion. They can talk about sponsoring $105 billion worth of financing, but that's on the cost of the actual chips. The cost to Nvidia, because they have 75% gross margins, is like 1/4 of that, right? So it's very interesting to see how Jensen Huang's Moat has transitioned from being really good at hardware and being advanced there to being really good at software. CUDA libraries, that was their moat. Now you have ROCm and all of these other potential homegrown solutions that people are saying, hey, you know what, maybe CUDA is not the moat anymore. Now the moat is actually turning into a capital moat. The lack of money in this system right now, in terms of the financing, which still, I mean, the bulk of financing is coming from operating cash flow. So people are definitely underestimating how much of this build out is still happening with cash. But whenever it comes to debt, there is an opportunity for Jensen Huang to finance that, but they want interest. Okay. They want equity. They want a piece of the pie if they're going to accelerate your build out, put you ahead of your competitors. I've said this literally for years. Jensen Huang and Nvidia, they are the kingmaker. They decide who wins. So if you want to be the person who wins, if you want to be crowned by Nvidia, then you're going to have to give up something, whether that's equity, whether that's paying them your interest expenses, whether that's taking on exclusive contracts. So you're not working with other companies like SpaceX, for example, just to say, hey, you know what, we'll pay your regular rates, we'll pay a favored rate, but we're not going to talk to AMD. We're not going to talk to Broadcom. We're not looking to create custom silicon. We're working with Nvidia. I don't think people are giving enough credit to the amount of these types of deals that favor Jensen. Maybe it's because it's been a while since the last time that we've heard him speak. But during this earnings call next Wednesday, I think that the ship is going to right itself back on course about just truly the position that Jensen has here. Over 100% growth, keeping up high margins, and in fact, will potentially point to, you know, not only the equity positions that they've been able to take on SpaceX and Intel and CoreWeave and all these different positions that they've made money on, but also the deals that they've signed with that capital that have allowed, you know, SpaceX to build out tens of gigawatts, CoreWeave to build out single-digit gigawatts, I think like 8 gigawatts over the next year or so. It's immense how well they're doing. So whenever people, you know, ask me like, why aren't I hedging? Why aren't I betting against Nvidia right now? I think they're in some of the better positions that I've seen that company be in the years that I've been holding it. And yeah, I don't think that the build out looks to be slowing down. So when it does, maybe we'll change course. Okay, we have a lot of different stories to be covering today. An amazing guest is coming on at around 2 p.m. So that should be really good. And I also want to talk about Chime and SoFi. I've been doing just some work comparing these two different companies, and it's crazy how much the tides have changed between their valuation over the course since Chime just went public, probably about 18 months ago. Okay. Chris's takes were brutal yesterday. Chris is, I don't know, like, it's one of those things where if you go up and you say, hey, if these companies are slowing down in growth, if they can't afford to pay for the build out, well, then that is bad news. It's like, yes, that, of course, that's bad news. It's just a lot of what ifs, you know. The thing that I forgot last time, and I was remembering it after the call, whenever it was like in the sauna, is like the last time that he was on, the big thing that he was harping on wasn't OpenAI's earnings. It was Meta's excess compute, because that at the time, Chris wants to come on whenever there's a, sort of the major headline that's getting him. Now, I don't think he's doing it nefariously. I think that he is worried. Like, I think that he's being very genuine and honest. But the last time that he got really worried and wanted to jump on was Meta's excess compute story that ended up happening, which got a lot of people very scared. And, that brought down the semis a ton. What we ended up finding out is that they had excess compute, quote unquote, and that they didn't slow down the build out at all. They actually continued to accelerate it. CapEx spend increased, and then they sold $10 billion to Anthropic. They also ended up putting out a model that I think was, kind of got brushed by because Grok was posting really good models at the same time. I think there was 4.5 at the time. And so people kind of brushed past that story, but it was a very good model, and their training has accelerated significantly. They haven't changed their playbook at all, but that was the old fear, right? Was Meta's excess compute, even though now they're talking about 14 gigawatts in 2027. I think people are looking to the canary in the coal mine and saying, like, okay, when does this thing stop chirping? And I mean, right now it's squawking, and there's from time to times where it remains a little silent, and people get extremely concerned. But the bulk, like the 95% of the evidence that I can find, is pointing towards a very bullish story, right? Even the July numbers, as Sarah Fryer put it, were more bullish than all of Q2. OpenAI ended up coming out yesterday, showing off their Q2 numbers, which ended June 30th, and posted, I think it was 6.2 billion or something like this in revenue. That posted 18% quarter over quarter growth, a little bit slower than a Palantir, right? But OpenAI is responsible for potentially $1 trillion worth of future commitments for data centers, and obviously sporting a large part of that to Nvidia, and partnerships with AMD, and partnerships with Broadcom. And there's the whole list of the entire chain that's being held up mostly by two major companies, OpenAI and Anthropic. If one of them is not growing nearly as fast as what people thought, major red sign or red flag. But in that regard, they also said, hey, we released ChatGPT 5.6 in July 6th, right after Q2, and July's numbers, just based on those 3 weeks that were left in that month, were more bullish, was higher numbers than what they posted in all of Q2. Because you really did see a lot of traction for people going towards more affordable tokens at, really high quality, and enterprises were really adopting that in their APIs. So their spend is accelerated. We've seen that in similar web traffic. We've seen that in token spend, in the lowering of token costs, but it's the same at the end of the day, whenever it comes to the chip amounts, it's not about the token cost. It's about how much that actually costs to how many chips does that actually cost to run the project, And that's the interesting thing. Even though people are talking about open source and the lowering of AI tokens and everything, the real company that's taking the hit is the model provider, right? Anthropic maybe has extremely high 70+% gross margins. Maybe ZAI, the GLM 5.3 creators, OpenAI, open source AI creator, might have gross margins of around 30%. And so they can offer their tokens much, much cheaper. But at the end of the day, how many GPUs do you need to rent out in order for customers to, infer all of your data and actually get the questions out at the other end is roughly the same. So to the data center provider, to the chip providers, the story doesn't really change. It's to the model providers, which many people have already, inferred that those are a commodity, that might end up getting hit. I'm not an OpenAI investor. I'm not an Anthropic investor. I'm not a ZAI or any type of investor on the model side. I'm investing in the, really 3 layers. I'm looking at the clouds, I'm looking at the actual chips, and I'm looking at the application. So, a lot of people point to the story potentially crumbling I don't think they're looking hard enough. I don't think they're seeing that Nebius just raised another 4.5 billion. No, Chris is most likely going to come on this week, you know, whether that's today, tomorrow. Chris is going to keep coming back, but I don't have a personal problem with Chris. I disagree with his ideas. I still want to hear those ideas. Because then, you know, I'm either going to be ignorantly in my own bubble and then fear me losing out a lot of money if Nvidia ends up falling. You know, like, what if he's right? I don't want to be right. I want to make money. You know, but I think that he's wrong right now. So I want to continue to do what I'm doing. And yeah, so like I'm never going to stop listening to Chris as long as he remains articulate in his ideas and respectful and all, and he is those things. So yeah, Chris is more than welcome on all the time. Okay. Tell me when so I can turn off stream. No, don't be like that. You got to listen. Like, he even said, like, you can listen to him and call him an idiot in chat. Like, do what you want. Like, you don't have to agree with him. Okay. Chris is too bullish for my liking. Well, you're in the Ed Zitron camp of things, where Chris is too bullish. Okay. Stripe agrees to buy OpenRouter. Uh-oh. We're getting down to the final marks of that acquisition. And it will go through. Private company buying another private company. I don't think there's too many concerns there. But very interesting. Okay. Let's go back to some of the news stories of the day. Like I said, Merck and Moderna hit their first positive phase 3 result ever for a personalized cancer vaccine. And I'm pretty sure it was, it doesn't say it here, but if I read correctly, it was for melanoma. Is that correct? Is an mRNA therapy custom built for each patient's own tumor mutations, combined with Merck's Keytruda, significantly improving recurrence-free survival in distant metastasis-free survival versus... Dude, even me trying to act like I understand, like hopefully this comes out well. You know, it would be cool to live in a world where we have a reduced amount of deaths that happen for cancer, and then we end up having some other sort of side effect that people then complain about, saying that Moderna ended up giving it to you for, even though average lifespans end up increasing. That would be that'd be great. But I'm just sort of a watcher of that. Yeah, I agree. Cancer is bad. I know. Risky take. Risky take. Okay. I'm skeptical. Yeah, I mean, I feel like there's all these types, but I'm not a healthcare guy at all. So it would be stupid of me to come up here and say I'm, you know, clearly the market thinks that this is extremely bullish. And I don't know the significance of the phase 3 trials. My understanding is, and we actually weirdly talked about this at the meetup, but that's the biggest hurdle, is going from phase 2 to phase 3. That's like that is the great barrier. So I think that's why the stock is running so hard right now. But yeah. If someone cures cancer, we should be excited. Oh, yeah. MELI up 6.5%. That's the one thing me and Michael Burry can really agree on is Mercado Libre. I was talking about this. I think Charles is in chat. If I'm not mistaken, it's Charles who said that. And he said, you know, I was reviewing your portfolio and the only thing that sticks out like a sore thumb is Mercado Libre. I don't understand this company. And I just had to tell him, I sat him down. I said, Charles, this is one of the greatest companies that you can buy right now. Mercado Libre is such an unbelievable juggernaut of making profit. This is the Amazon of Latin America. They have a ton of customers, a ton of profit. They also have a fintech. So you know how Amazon kind of has Amazon.com and then it has AWS. And honestly, for the most part, those are two separate businesses, right? They're completely disconnected. And honestly, it wasn't even, you know, you could say, well, it's an internal cost saver and all of these things, but Amazon.com didn't even run on AWS for a long time. It was running on Oracle. I know that because Larry Ellison made fun of Jeff Bezos multiple times for using. You never see a lot of CEOs bash their customers, but he was bashing Jeff Bezos. What's it called? So there's less cross-sell between, I think, those two big areas of Amazon. Where there's more cross-sell, I find, is between Mercado Libre, which is, you know, their marketplace, and then Mercado Pago, which is their fintech. And those fintechs and marketplace ideas really do cross-sell. Hey, use our credit card, get cash back. You know, direct deposit here. If you have a certain amount of, you know, different products or rewards with us, we'll give you discounts at our marketplace, faster shipping, priority, you know, priority placements in orders and these sort of things. There's a lot of cross-sell there. So they also have credit solutions and logistics and a very amazing company. So they deserve to be above $2,000 a share. I really like them. Okay. Let's see. I want to put on CNBC really quick. And then I want to talk about SoFi and Chime. SoFi, by the way, up 4%. A little bit of a sell-off starting, but still good day today. And Chime up 2.5%. President Trump says that we have a deal with Canada. I've not seen this, so let's go ahead and quickly have a listen. But yeah.
We are getting some breaking news out of Washington on a potential trade deal with Canada. Eamon Javers is in D.C. Eamon.
Yeah, Leslie, President Trump's been speaking to reporters at the White House at an unrelated event, and he took some questions talking about that decision that he made last night to offer a 3-day pause in hiking tariffs on Canada. Here's what he had to say.
Canada was charging us tremendous tariffs. We no longer have any tariffs. And what I was able to do is we put, as you know, under the new tariff, I guess you'd call it the new tariff schedules that we came out with. They were going to get a 50% tariff on everything starting today. And we've held it back 3 days. It's all subject to finalization of documents. So subject to the finalization of documents, we have a deal with Canada. And I think it's a very good deal for both parties.
So you heard the president say, subject to the finalization of the documents. And that's the key to this. We don't know from the outside looking in what the terms of this potential deal might be. The president floated the idea on social media of a potential extension of the Keystone XL pipeline that had been suspended back in 2021. He said that may be part of this. So we just don't know. We've seen some statements from the Canadian side over the past 24 hours that have been a little bit more circumspect about all this. But I can tell you guys that we have an eagle-eyed producer out at the U.S. Trade Representative's office right now, and she just spotted Dominic LeBlanc, the Canadian Trade Minister, entering the USTR for what we think might be a 30-minute meeting over at the U.S. Trade Representative's office between the U.S. and Canadian side. So we'll watch for that. see if LeBlanc has anything to say when he emerges from that meeting. Might get one or two more indications of some of the terms of this deal. That seems to be, and there you see the video of the arrival of the Canadian trade minister. That is just south of the White House complex at the U.S. Trade Representative's office, where he's entering right there, and obviously surrounded by a lot of reporters who want to know the same thing we want to know, which is what's in the deal, guys. Back over to you.
Yeah, if there is a deal. I mean, it was interesting to have Carney be the one this time to pump the brakes a little bit and say there's more work to do. But clearly, we'll await more information, Eamon. Thanks, Eamon Javers.
Okay. Yeah, BMNR and SBET are moving. Crypto is really moving right now. A little bit of a sell-off starting. Not too much. I think Fintech might also be following that a bit. And Ethereum back above 2,000, but it's up 8%. So if we go ahead and we look back over the last 3 months, you can see how big, that rally just came in comparatively to where we have sort of been stagnant at that almost 1850, 1900 range. But this only brings us back to around May pricing. We still have a long way to go before we start hitting new highs again, which is where BMNR stock price is really, really going to start ripping. Now, to be fair to BMNR, by the time we do end up starting to see some appreciation in the stock or in Ethereum's price, we've acquired a lot more overall Ethereum tokens, right? So the rip back here, whenever we had 2% or whatever of the outstanding shares of Ethereum, it's going to be a lot different now that we have 4.8, almost 5% of the outstanding amount of shares. If this was the bottom over here and we're going to start ripping back, who's to know? So I remain having a very small overall stake in BMNR and haven't trimmed that quite yet. Okay. Let's go ahead and talk about what was it? Oh, sorry. I just got to write this out. Let's go ahead and talk about SoFi versus Chime. This is two different fintechs that I think I wanted to cover because people have really been pointing to Chime's stock price reaction after last earnings and saying that Chime is the real fintech winner and that SoFi has been a loser for years and not worth holding and really not performing the way that Chime is performing and the way that SoFi should be performing. So before people start freaking out and rotating their portfolios, I wanted to give not just the numbers for Chime, not just the numbers for SoFi, but really put a one-to-one comparison on as many of the metrics that we could compare one-to-one. And there's still some parts where it's not exactly a one-to-one comparison, but it's as close as we can make it based on the numbers and the data that we have. Okay? So I'm sharing nothing. Let's quickly talk about Chime versus SoFi. All right? Which is the fintech name that deserves an investment from you? Which one deserves to be cut? Let's have a look. First up, we have to talk about overall members. Now, this breaks out into two different categories: SoFi's total members and Chime's active members. This is where we don't exactly have one-to-one data on this. Now, whenever we look at things like revenue per member, it's going to greatly benefit Chime because it's not every member. This is only members that within the last month have made a revenue-producing decision, like whether that's tapping your debit card on a machine or, making an instant withdrawal or, using MyPay, which is one of their services. Those types of things would consider you to be an active member. SoFi just counts the total amount of members that have funded accounts on their platform. Okay. So this is the difference. Now, there's two different things that I want to point out. One is the total amount, nearly 15.8 million versus the overall 10 million of Chime, but it's really the growth rate as well. Okay. Even though Chime could have a lot more members total than SoFi, the growth rate should technically be the same because you don't want to have less overall members being active members over time. So if Chime was a faster growing business, they should still show up as a faster growth rate here than SoFi, and they're not, right? You can actually see this here. SoFi's 3-year increase, about 153%, Chime, about 76%. Even if the total number of active members or total number of members on Chime is higher than SoFi's, excluding their active members, it still should be of similar growth rate, and it's roughly half, okay? On top of that, whenever you talk about the total amount of new member adds versus the active member adds that Chime has, SoFi is not only extremely high, but that difference is actually getting wider and wider. They are just bringing on so many new users right now, and that's leading to overall revenue. Now, this can be compared one-to-one. How much revenue are you bringing in, which then flows down into profitability eventually, and we can talk about that in a second. One, you end up seeing back in Q2 of 2023, SoFi brought in about $488 million. Around that time, Chime brought in around $300 million. Very close, but obviously this has scaled, and SoFi has continued to put up extremely high growth rates on their revenue, which has brought them up to over $1.2 billion. Chime around $670 million of total revenue. That growth in overall revenue has led SoFi to grow about 146%. Chime grew at around 117%. This is an exact equivalent, okay? On top of that, whenever you talk about revenue per total member and revenue per active member, which should greatly, greatly benefit Chime because you're cutting out all the people who are not making money. SoFi, we're including everyone. Still, per active member, every single quarter for the last 3 years, SoFi has made more revenue per member than Chime. Huge, huge flex there for SoFi. And then on top of that, whenever you're talking about profitability, and we don't just need to talk about the sheer dollar amount, what I'm really looking to here is the margin. Every dollar of profit that comes into the platform, how much of that is flowing to the bottom line from an adjusted EBITDA standpoint, because Chime isn't really net income positive, or at least not for the full year. So that's not a great comparison. I'm trying to compare them on a margin that at least would show up for them. And still, we're really about double the profitability, comparing a 15% margin to a 30% margin. And that's been consistently high, higher than Chime for the last 3 years. Okay, so way more profitable. And maybe partially because of that is how they acquire a customer. SoFi acquires a customer for roughly about $300 to $350 per user, and that's been pretty consistent for the last 3 years. Okay, sometimes a little bit lower, but they've been actively trying to spend more. Now, Chime has these spikes here in Q2s, so I wouldn't compare it one-to-one on Q2, but it's really where they see a big lack of new user growth because they have people falling off the platform, and the churn's really high on Chime. It's roughly 50% of people delete their accounts, stop using Chime within the first year, okay? So Q1, the reason why you end up seeing Q1 have extremely low customer acquisition and then Q2 have extremely high customer acquisition is because they bring all the users on Q1, they have tax benefits, they're trying out the platform, and then they leave the next quarter. SoFi, you don't really see a lot of churn ever. And they kind of have a consistent way of monetizing their users. So whenever you're talking about consistency, SoFi also wins here, in my opinion. Not to mention even a lot of the quarters that even are just regular quarters like Q3 and Q4, Chime still ends up having higher customer acquisition. But that brings me to valuation as well. One is a faster growing business. One has more overall members. It's a faster growing, more profitable company. And that brings us to where does this sit from a forward price to sales ratio, okay? Chime used to be much cheaper, deservingly so. And as of recently, as of this latest tick up in their overall price, that ratio has essentially brought these companies to an even level, even though their guide is way worse. I mean, like 20+% growths, much lower margin than SoFi. SoFi has, 30+% growths long-term, even though they're putting up 40 today. And 40% EBITDA margin, 40% EBITDA, EPS growth. That's what I meant to say. 40% EPS growth. They're still roughly about the same price on a forward price to sales ratio. And then forward price to earnings, that profitability, look how cheap SoFi is getting in respect to Chime. Chime in blue here, SoFi in orange. Chime ends up showing up with a 49.7 times on the forward PE, SoFi about 24 times. So if you are investing in a company like one of these very fast, new, agile fintech companies, I have to give a lot of credit to SoFi here at these prices because they have great, it's a great price to be buying the company, higher growth, higher margins. There's really not a reason to be betting on Chime right here, in my opinion. So just a quick little update on why, I'm kind of rotating out of my Chime position and potentially even putting more of it into SoFi, which I've not made an exact call on that right now. It is one of the biggest positions in my entire portfolio, but there's a reason why I continue to be extremely bullish and excited about the company's future is because they are executing. There's some companies that come in and can seem like, really hot names, but it just comes down to the numbers eventually. What's your revenue growth? How much are customers staying on the platform? What does that flow to the bottom line? SoFi wins across the board. Anyway, that's my little bit of my commentary on Chime versus SoFi that I wanted to talk about because I was comparing them yesterday to think, does Chime deserve this sort of run up versus what happened to SoFi? I'm not sure. Obviously, I was a shareholder of Chime. I was buying this in around the $16 range. And now we are seeing a big appreciation in this company in the last 3 months, especially after earnings. You saw that big earnings pop, okay? But now it's getting back to territory where you can really start to price it very evenly with SoFi. And SoFi looks cheap. SoFi looks cheap in that regard. And look at that. Yeah, I am making Chime run. I don't know, man. SoFi looks good. Even the breadth of products and like the amount of money that they can make, SoFi they have all the areas. They've got the bank charter. They've got, crypto and invest and all of these things that Chime wants, but they don't have right now. And we know from the way that SoFi ended up taking extremely long to build out those products. Multiple years. Extremely expensive, hundreds of millions of dollars. This isn't cheap for Chime to do. It's not a free new revenue source that is just going to get tacked on instantly. This costs money, and it's it'll take some time. We'll see. Also, like even having an invest category, just think about the types of users that are coming onto Chime and the types of users that are coming onto SoFi, right? You have SoFi with customers that make on average, 6 figures, they have the money to invest. Chime, their average customer makes less than $75,000. They consider people who make over $75,000 as their affluent customer base. So, depending on, the platform, like average user, really goes to show you who can even utilize their products to their fullest degree, who has the most spend capabilities, who has the most ability to invest or protect or do all these different things amongst the product suite that they have and what they're offering. Yes, FOMC minutes in 15 minutes. Once again, like every single one that doesn't have a meet, I don't expect too much. We'll still read what they have to say, but especially under Kevin Warsh, I don't expect a ton of commentary. He's been a little bit headed in the direction of less commentary. I think he even proposed that they do less FOMC meets per year. But who knows? Okay. Have you ever looked at Sprinkler CXM? No, I have not. I'm not in the healthcare space, so I don't really have a take on Moderna. You'd have to look to somebody else, I'd be curious, like, what's Martin Shkreli's take on Moderna? Is this legit? Should this be running up 150%? I did hear that shorts of Moderna are getting smoked right now. Moderna's short sellers, and this was actually earlier whenever the stock was not, above $150, said that they're now facing according to Ortex data, $4.8 billion in mark-to-market losses today. $4.8 billion in short sellers getting wrecked. Because that's the thing, right? Whenever you're short selling, you have to, like, this is the perfect example of why you don't short. The most you could have made, the most was, 100% or 99.9% without leverage. But if you include leverage, let's say, then this even gets worse. The most you can lose on short selling is a day like today. Moderna is up 150%. For those types of short sellers to rebuy those shares and close out their shorts, by the way, the entire time that they have the privilege to make less than a long investor, they had to pay for that premium of borrowing someone else's shares. So they were doing securities lending. That's costing them money. And then on top of that, they lost more money than what they had in the stock because it's up 150%. And this might not even be the top. There's no end to the top on short sellers, or sorry, no end to the the potential losses. Did you see Amit's Moderna trade? I did. Yeah, he made a little bit of money in like 3 minutes of owning the stock. He's got a little trading portfolio going. It's fun to see. I'm not degen enough to try that sort of stuff. Okay. Moderna is the new GME. Well, I mean, GME never cured cancer. Which, by the way, speaking of which, we literally talked about that with Chris about how potentially hard that was. So it's freaky timing to see some sort of cancer story get pushed out the day after. Goldman Sachs is preparing a roughly $1.15 billion junk bond to finance a Virginia data center leased to CoreWeave. The deal is expected in September, with Goldman moving ahead even as investor demand is seeking higher yields for AI infrastructure debt tied to CoreWeave. A separate $3.5 billion CoreWeave financing recently got priced at a 10% yield. Wow. Yeah, I didn't realize it got that high. Their total amount of expenses on their debt, I think, is around 6.6%, 6.5% annually. So we'll see how that climbs. CoreWeave, though, pushing ahead. Jesse, welcome, brother. Welcome. All right. Reddit's a good buy here. Well, I already have Reddit in the portfolio. Maybe I'll look to acquire some shares, but yeah. Patrick Collison just tweeted about the Open Router Stripe deal. Let's see what they have to say here. Stripe, the programmable financial services company, today announced that it has agreed to acquire Open Router, a leading AI model gateway and routing platform. Open Router helps businesses route and optimize token usage across 400 plus models from more than 80 providers. Okay, I just want a summary of this, though. I want to know why they bought it and what's the purpose. Why does Stripe care about this business? They treat the symptoms, not the underlying cause. Okay. We'll have a guest joining us in, well, I told him if 2:10 can work, just so that we can get at the FOMC minutes Fed minutes, I should say. And then he'll be joining us. We haven't had this user on our channel for quite a while. We actually, I'll give you guys some hints. You guys can, I'll see if you guys can guess. We used to have a show together, probably ran 3 or 4 episodes. He is a very sophisticated investor and has not been on for a long time. Those are your hints. You'll see him here in about 20 minutes. Roy's been on days ago. Amit's been on. I've had way more episodes of a show than with Amit. I've probably had like shows that I've done 50 episodes with Amit. Chris was on yesterday. I did see someone guess it. Someone got it right. But I'll let you guys figure that out. Okay. Let's see. Trump is delaying the tariffs against Canada. We talked about that already. Trump spoke for himself. Amazon is expanding drone delivery. I think the stock is up right now, up 1.9%, along with most of the Mag 7. Amazon will bring Prime Air to suburban Chicago and Atlanta, plus Metro Cleveland and Syracuse by year end. That would grow Amazon's drone delivery footprint roughly 6x from today and put that service within reach of 30 million people by the end of 2026. Very cool. Amazon has their own drone. The MK30 has a range of about 7.5 miles and has already completed hundreds of thousands of deliveries to date. I'm up in Canada, so I've never seen these types of drone deliveries before. Is it weird? Like, is it freaky or is it perfectly normal? Drone delivery will be a real thing. I just wonder whenever the peasants up here in Toronto are going to get it. Okay. I'm seeing everyone guess who's going to be on. It's funny. I hope it's Burry. FOMC in 6 minutes. Yeah, I know. We're just waiting for that right now. I'll get you guys the story as fast as possible. We'll read that out together. Okay. The tentative trade deal between the United States and Canada would lower tariffs on certain Canadian exports of steel and aluminum to 25% down from 50%. Oh, I also wanted to see what was the reason for Stripe to acquire OpenRouter. OpenRouter says that its name, product roadmap, and model neutral approach will remain unchanged. The financial terms were not disclosed in the official announcement. And the acquisition remains subject to customary closing conditions and expected to close within weeks. Stripe also said that they are evolving beyond payment processing towards the economic infrastructure layer of artificial intelligence, controlling the routing, metering, and billing of AI consumption. Pretty freaking smart. Do you think that this will lead to more competitors, though? Or does OpenRouter already have the data and the moat? I'm looking more towards the software engineers. Like, how crucial is OpenRouter? Will we watch Trump around 2 p.m.? No, I've got a guest joining at around 2:10. And we're going to do the FOMC or the Fed minutes here in a little bit. Okay. I'm up on my Moderna short. Well, congrats. Let's see here. The better the tokens, the gooder the tokens. Okay. Dude is shorting cancer research. Yeah, this guest is going to be a very good one. What I'm going to do as well is they have a pretty wide range of different stocks that they cover. So after a few questions that I have around AI and, you know, some of the Mag 7s and stuff, I'm going to go to a little bit of a lightning round and just spit out an individual ticker. And I'll want your help if you guys have a ticker that he potentially will cover. If I see it pop up a lot in the comments, I'll ask them about it. So think like Technical Tuesday with Jason, putting in your tickers, but with a little bit of commentary from the guest. Don't put it now. It's not going to get read now. Might help if we know the person. No, but that would ruin the surprise. I'm like I said, I don't want tickers now. Do it whenever we're in the lightning round. But yeah. Okay. FOMC or Fed minutes should be out in 1 minute. Let me know if you guys have it. I'm going to keep my my thing open. In fact, what we can do, maybe I can just open up CNBC and just let them cover it in real time. That way I don't have to work so hard. Oh, they're in commercial break right now. What great timing. Okay. So bonds down, stocks down, oil's down, but crypto is up. Well, I don't know what stocks are down, but the S&P and the NASDAQ are both super green. We got App Lovin' up, Home Depot, Airbnb. It's pretty wide ranging, actually. If we were to take a look at a heat map, there's a lot of green here. Now, semiconductors a little bit red, but maybe a little bit of diversification in the rally is good, you know? Okay. We should be getting these minutes any second now, or Fed minutes any second now. I've got my X up. I could just go directly to the Fed committee website. But let's go ahead and listen to CNBC really quick and have them cover it.
They're lower, all under the surface of an otherwise quiet day for stocks. Welcome to Power Lunch, everybody. With Kelly, I am Brian. Long-dated bond yields, they're down. Uncle Sam stepping up the debt buybacks. In the meantime, healthcare, energy, new records, the setup for markets, and the fate of the AI trade, all coming up.
And remember this guy, Coy? He was on set with us just months ago. Now his parent company.
Okay. Unitree did go public. We should have talked about that. I can't believe. Fed said many said hikes are likely needed if inflation didn't decline. Okay. Let's see what else. I'm seeing a lot of Starlink news here, not about the actual Fed minutes. Okay. Once again, yeah, no hikes, of course. S&P is seeing some green candles, but I just want to see the actual report. I just want to read what they said. Several said tariff pass-through was now largely complete. Participants judged inflation risks were skewed to upside. How do you have access to CNBC from YouTube? I don't have it from YouTube. I have it from CNBC. S&P climbing higher, now up 0.4%. NASDAQ also up 0.33%. Nice little rally. FOMC minutes. Many participants assessed that policy tightening would likely be necessary if inflation did not decline. Some participants commented that financial conditions might not currently be sufficiently restrictive to facilitate a return of inflation to 2%. Various participants suggested that financial conditions had tightened over the intermeeting period, and that this development was partly a reflection of strong economic growth and market expectations that the committee would adopt a more restrictive policy stance before long. A few of the participants who favored raising the target range for the federal funds rate at this meeting, and then I'm cut off. Anyway, no decision was made, and they didn't change the meeting schedule or anything like this. Let's see how the Fed Watch changes as well. But, okay, I'm going to let my guests know to pop on. Hop on whenever. Okay. Let's see here. We talked about the CoreWeave deal already. Elon Musk says Starlink could eventually carry over 90% of the internet's traffic. There was actually an update. Starlink just recently said there's now 11,000 satellites in orbit, more than twice as everyone else combined. Musk also is talking about Starlink potentially reaching scale of 100,000 satellites with their new V3 satellites that they're pushing out now. And Starlink is also live in 167 countries around the world. SpaceX down 2.4%. Okay. I swear there was one person who guessed the guest. That was it. Everyone else has been wrong. No one else has said the name in a while. But that being said, Bitmine, a lot of the crypto names still up a ton. I'm curious to see where crypto went after the Fed minutes. And what am I looking for? Bitcoin. Duolingo up another 5.5%. And Moderna up still roughly about 143%. Okay. It's not Riley. It's not Amit. It's not Matt Money. It's not Tevis. I like how some people are actually thinking outside the box. I said it's someone who's not been on for a while, and then people say like it's Amit or it's Matt. It's like, you guys got to think a little bit harder than that. Some people are saying Arnie, Stock Talk, Meet Kevin. At least those are out of the box. Jeremy Lefebvre, we've definitely done a few things, but no, this person's been on more than that. Okay. It's not Sam. Someone did guess it. Okay. Let's see what else. I asked them to come on, but I don't think they've even seen the message yet. Okay. What is the Unitree ticker? I got to check that. I didn't follow that one yet. I'm sure it's one of the numbered tickers. Let me double check. It is P. It is P Diddy. P Diddy's coming on, talking about his favorite stocks. Okay, this should be the ticker. That looks like the ticker. Up 460% today. You Show Technologies. Is that correct? That's pretty wild. Yeah, I know. People's guessing is wild. Okay. I want to ask about the whole AI craze that we're seeing. That's going to be the main topic. This person I don't think is part of the echo chamber. I think they're going to give us a little bit of a mixed review, of course. Amit also posted online, I saw this, about Alex Karp at the latest Sovereignty Boot Camp. They said nearly 200 organizations attended Palantir Sovereignty Boot Camps in the last 30 days. We'll talk about that actually in a little bit, but I want to bring on the next guest. Ladies and gentlemen, please welcome the great and powerful Brad Freeman.
Just Brad Freeman. No great, no powerful necessary, but how are you doing, great and powerful Tanner?
I'm doing well, man. I'm happy that you're back. I have not seen you on the show in a while.
Yeah, too long, for sure.
What's called? We were just talking about Palantir. This has actually been a name that I know that you've been actually considering a little bit most recently. Obviously, the valuation's changed pretty drastically.
Yeah. Just need a time machine to go back and buy it when it was around 100. Like I was so tempted to do and didn't do, and then you look up a split second later and it kind of got away from you, or not you, but me, I guess. But yeah, it's all been for Palantir. I mean, what an amazing company. There was about a year of people figuring out whether app layer part of the AI wave was going to monetize. Well, they were doing it better than anyone else and have continued doing it better than anyone else. And they talk a lot of smack and they deliver results that warrant even more smack than they talk. So it's just, yeah, they're awesome. Nothing wrong with the company at all. Nothing but right things with the company.
I like how conservative you are. You have your time machine. You'd go back and buy it at 100.
Oh yeah, I should go back to 8. I need to go further back in the time machine. You're right.
I do want to talk to you though about a lot of the Mag 7s. You practically cover them all, maybe without Tesla or something like this. I don't know if you do cover those names, but for the most part, a lot of the actual big tech companies. I'm curious on the state of sort of the CapEx spend, artificial intelligence. How do you sort of wrap your head around all this? I don't think you've been sort of sold into the AI craze like potentially I have, or some of the other ultra bulls or perma bulls, as you would put it.
Well, I definitely wouldn't call myself an AI infrastructure bear. I think you'd have to
not bear. Just
I know that's not what you were insinuating. You kind of have to stick your head in the sand and ignore everything to be not. I mean, at least a little optimistic about everything that's happened over the last few years. But in terms of ROI, or in terms of quality of CapEx, and do I think they're making the right decisions? Absolutely. I think this is a case where public market incentives and long-term what's right for a company don't always align. And I think it's part of the reason why you see some companies just get so big in private markets and kind of refrain from going public, because it's a lot easier to make, I guess, decisions that don't always fixate on maximizing a quarterly EBIT number, beating a sell side EPS number by 2 cents instead of 1 cent because the whisper number said you had to for your stock to go up 7%. I mean that's the game that public markets play every 3 months. And if you want to sometimes create more space and more runway for more profitable growth and becoming bigger in the future, you have to kind of sacrifice in the near term the things that make everyone happy. So I think that, I don't think that's definitely what's happening right now. Meta is the one that people are most worried about, just because they don't have that, or at least right now, I guess right now they don't have that public cloud business where they're renting compute to a lot of customers for very near term returns and high margin revenue. There's been a ton of rumors about them getting into that, as you know already. But I'm of the opinion that CapEx is a good thing. I'm of the opinion that CapEx is based on near-term and clear demand signals that people with a lot better data and a lot closer conversations with customers have than anyone on X and people offering opinions. So that to me is a phenomenal signal that they still see things that are very rosy, at least for the near term. And that doesn't mean they can't double negative, but they can always pull back on CapEx. They don't have to spend $1 gazillion in 2 years like some of them are still saying they're going to be. But as of right now, everything looks really good. And even for Meta, I mean, they talk about using AI AI investment dollars all the time to accelerate monetization via more engagement and higher ad pricing. So it's just, I think all these companies are doing the right thing. And even if not all of them are getting credited for it right now, I think they will be in the future. And then I'll get off the sermon in a second because I want to hear your take. But the plan B is really good too. I mean, if you have too much compute sitting around, which I don't think we're really close to a scenario where that happens. But if you do, especially for a company like Meta, you just pull back on CapEx. You maybe rent out a little bit of the compute, and you see your free cash flow number go a lot higher. For Google and Amazon, you probably have lower cloud growth that you have to figure out how to plug that gap somewhere else. But the free cash flow number that everyone's worried about being so negative, it's not a new normal. Like I think many are assuming it is. It's a matter of let's cut CapEx by 30 billion next year and watch free cash flow magically spike higher, and that will happen. I'm not sure when it will happen, but it will. And so yeah, I don't worry that much about these companies making good decisions, and I don't worry about them making pivots when they think they made a good decision and it turned out to be wrong. A la Metaverse 2022 in year of efficiency.
I was talking with Chris Patel yesterday, and he believes that some of these companies like Google and Meta are being blinded by, competition being so strong that these companies are more worried about what their balance sheets look like, less worried about what their balance sheets look like and more worried about falling behind and potentially losing market share. Do you think that we could be in a phase right now where these companies are overspending and that they could actually be getting themselves into a lot of trouble? Or do you think that they're good capital allocators? Because Chris was making some statements yesterday about how Google might not be a good capital allocator right now.
I think it's almost inevitable that they will overspend at some point. I think to get to the perfect amount of capacity and then stop at the perfect time is not a real. I don't think that's going to happen. I mean, that'd be really cool. Pat yourself on the back if we could pull that off. But there is going to be a time where there is overspending and overcapacity. I just think they think the economic gain from getting to that point, from going from where we are now to wherever that point is where we have too much, is that there is not only too much profitable revenue to make, but there's too much, compute to lay around the world to ingrain yourselves in developer ecosystems, and like data lakes and all of these things that create sticky customer relationships to make sure that not only you're buying your AI workloads on AWS or through Azure or through wherever you're doing it, but that your core workloads, which AI is directly supporting, are also there too, so that you can have this sticky, holistic relationship where you're not. It's kind of the same thing as app layer, point solution versus platform. Like everyone wants to be that platform. Everyone wants to sell a lot more tools to customers because they stick around for longer. So yeah.
Yeah. Now, how does a company like Nvidia, and don't hurt my feelings, it's obviously last time we spoke, it was the biggest position in my portfolio. It still is. And the stock hasn't moved, I don't think, since the last time we spoke. So
look at the 5-year chart, and then you're only up 986% over the last 60 months. I'm playing the world's smallest violin for you right now.
No, it's just the AMD guys that have been trolling me over the last 18 months, saying I should have rotated every dollar I've ever had into it.
Well, there's another use case for Time Machine. So
yeah, exactly. But how does that fit into the equation for you right now? Does that company look cheap? How do you sort of value the biggest company in the world right now? And you could fit in the Broadcoms, the AMDs, and sort of just the entire infrastructure.
Sure. Well, I think the news with like BlackRock and KKR last week with the financing and maybe creating financial markets behind GPU sales and compute, I think that's really big for NVIDIA, just because it's sort of almost like on a much bigger scale. It's almost like Uber with autonomous vehicles. Like they're investing in a lot of companies because they're trying to bring a lot of more customers through the finish line, so they have more business to have more supply on their platform. NVIDIA is kind of doing it in sort of a related way, in that they're funding a lot of members of their supply chain to make sure that all of these pieces of their supply chain are healthy. Also, to make sure that their potential customers can keep buying their GPUs and renting them out to other people. So that costs a lot of money, and I mean, very few companies in the world have a balance sheet that looks anything is close to as amazing as what NVIDIA has. But it's still really nice to see all these massive institutions step in and commit that, I think, what was it, $500 billion of maximum funding over the next few years in terms of creating these capital markets for not leaning solely on NVIDIA to foot the bill for everything, which means whenever this cycle does end, and I don't know if that's going to be in 2 years, it certainly doesn't look like it's going to be in the next few quarters, but a year, 2 years, 5 years, I don't really know. They're not holding all these assets that are maybe not as in favor as they were during the hot part of the cycle. So it creates a lot more balance sheet flexibility for them to ramp up the buybacks, to do a lot more things without worrying about CoreWeave or some of these other partners having cash on the balance sheet, or not worrying as much about these supply chain partners having enough cash on their balance sheet to fulfill their commitments and to fulfill their orders, and to make sure their piece of NVIDIA's backlog is looking safe and healthy. So I think that's good. That was really good news for NVIDIA. That was a good development. And in terms of cheap or not cheap, it's as crazy as it sounds. I mean, what is it right now? It trades for, should have this pulled up already, 22 times forward earnings, and earnings growth over the next 2 years looks like 91% this year, 40% next year, 22% the year after. So the growth multiple is way under 1. If you are of the opinion that this infrastructure cycle has legs, and again, 2027 CapEx commentary for mega caps looks pretty good for that. The fact that the scares we've gotten from Meta about maybe having excess compute have definitely been false alarms, and kind of
those blew over quick.
Yeah, for sure. So I don't think cycle longevity looks like a pressing issue right now. But whenever that happens, NVIDIA is not going to be the first person to say the cycle's over. Like, it's going to be unpredictable and quick and sudden if it's like any other cycle. So I don't know when that happens, but as long as status quo remains or even remains kind of this good right now, it looks super attractive from a valuation point of view. In my mind, at a $5 trillion or whatever it is market cap, kind of wild to say. But yeah, peg under one for a name like this. As long as those estimates look good, yeah, looks good to me.
So what I wanted to do is play a little game with you. You cover a wide variety of stocks. I also know that you stick within the areas that you know. And what I want to do is have people essentially put in a ticker in the chat. I've got some of my own that I want some, commentary on. And then we'll just do a little bit of a lightning round of what your thoughts are on the company. You don't have to say, buy this, sell this, just this is what you're thinking about the name, or very quickly, I don't cover that name.
Okay, perfect. As long as I can be like, I have no idea, we're good. Yeah. Okay.
Yeah,
awesome.
exactly.
I promise I will say I don't know instead of making up a stupid answer for a company I don't know anything about.
Perfect. I want to start right where I've been looking a lot into, which is some of the neoclouds. And I guess we'll kind of lump together both Nebius and CoreWeave. Some of your thoughts.
About as levered directly and purely to the AI infrastructure cycle as you can possibly be. Large beneficiaries of excess compute demand and data center demand. As long as that lasts, their ARR numbers are probably going to look amazing. I don't know what their profit numbers over the long term are going to look like after EBITDA, because depreciation is a super important expense for them. And I don't think anyone valuing them on gross profit or EBITDA should be doing that. So that I don't know, haven't done enough work on those names, but revenue and demand numbers are probably going to look unfathomably good for as long as this supply-demand imbalance in AI compute lasts. And it doesn't really look like SpaceX leasing out compute to Anthropic or maybe Meta doing the same thing is going to have any impact on that. It looks like supply-demand imbalance is firmly intact, and Nebius had an amazing quarter. These companies are killing it right now.
Uber.
I misunderstood blue chip. I think they are going to be the demand aggregator for all of these tiny little AV fleets that are forming that no one has heard about. I think there's going to be Waymo. I think there's going to be Tesla, and I think there's going to be Uber. I don't really know what's going to happen to Lyft. Maybe Zoox with Amazon buys them and tries to merge, or maybe Uber just grabs them to take a little bit of market share. But I think there is a large three-headed monster forming in the AV land over the next 10 years. And while we get from point A to point B, Uber is just going to keep compounding at a mid-teens clip, trading at a very cheap multiple for a long time at massive scale. So I high on the company for sure.
Really quick, because I argue with
Actually,
Tesla.
One more thing, sorry. Didn't love the fact that Waymo is kind of pulling back from their relationship. That kind of upset me a little bit.
Yeah.
It made the bullishness a little bit more cautious than if you would have asked me maybe 3 or 4 weeks ago.
Yeah, I've not been following Uber super closely, but my understanding was I think they launched in Phoenix with Uber and Waymo, and that they had like some of the highest utilization that they've ever had. And for some reason they're pulling back on that relationship. I didn't understand that.
So it was a very small, like a dozen or 2 dozen car experiment in Phoenix. They're also in Austin and Atlanta. That partnership apparently is getting renewed for 27. I think there were some disagreements over pace of rollout, over maintenance responsibility. I think that companies just kind of got into some bickering arguments or bickering matches, and that led to Phoenix kind of fizzling out. But I think it definitely makes it more likely that Atlanta and Austin are also going to fizzle out at some point, which just makes it all the more likely for Uber to perfectly piece together this web of vendors coming to market. And like talked about with Nvidia a little bit, they're having to invest billions of dollars from their own balance sheet to make sure these companies are succeeding and getting to commercial scale.
AppLovin.
Oh my goodness. Either a one-off event with weird model update timing, and it truly was a model cadence thing, and they got it updated, and now everything's rosy and they're back to killing it every quarter. Or that was the first excuse of a new trend of excuses of why things don't look quite as good, because in ad tech, it is very, very hard to, over a several year period, convince companies that you can monetize the impressions that you've already earned better with us than you can on your own, especially in the age of AI, where everyone is making targeting and data collection and analytics a lot easier. So when I hear AppLovin, I think the third quarter is so important for them. Talked about this with Shai on our podcast 2 weeks ago. If they give another weird excuse like we didn't ship this update in time for a little more revenue to flow in like last quarter, or something else happens, you're going to hear Trade Desk 2.0 murmured over and over and over and over and over again. Everyone is going that is going to be the comp that everyone points to, and I think it's going to be fair. But it's only it was one quarter. The best companies in the world have had bad quarters, have messed up. So if they get back to their old ways on Q3 and Q4, then they're fine.
I got super burnt on the Trade Desk. I started buying in after that first quarter where they dropped from 140 down to like 60, and then I was buying. And then the next quarter there was a reacceleration, and Kokai is off to the races, and we are now going to see this new AI platform start to really show off strengths. But I find if you get 2 quarters wrong in like a 1 year period, that was the end of that. So
yeah.
And now I'm not buying in AppLovin. I'm not buying Zeta. I'm not touching any of these names because I'm so scared of the Trade Desk. I've got PTSD.
Am I too boring for thinking Meta and Google are the best ad names in ad tech, and why go anywhere else? I don't know. Maybe I am, but yeah.
What I say on my channel a lot is I want to own the user now. Like at the end of the day, the only thing that I'm focused on, like Reddit, Google, Amazon.
Yes, only impressions.
Yeah, because at the end of the, you don't know what they're going to be able to build, how much they're going to be able to bring in-house. And the vertical integration starts by owning the user.
I totally agree.
So just really quick, do you want to speak on Zeta if you have any thoughts there?
I don't know much about it. Can I ask you about Spotify? Speaking of users, and what do you think of that name? If you know anything about it,
I don't know anything about Spotify.
Okay, because it's on the watch list. I've been talking to a lot of people trying to maybe put in the portfolios. I'm just collecting feedback. But sorry to go impromptu and role reversal.
Yeah. No, you know what company I've been really spent my whole weekend looking at? Bending Spoons.
Bending Spoons.
Bending Spoons.
It's
very, very new. They just went public like a month ago.
Okay.
Italian owned, like think of like Constellation Software or Berkshire Hathaway. They acquire businesses outright, fix them up. So they acquired Eventbrite, AOL, Evernote, StreamYard, the platform that we're using right now. And they buy these companies that are sort of forgotten SaaS names. Airtable, they just bought that name, and hold them for the long term. So they've done over 50 acquisitions, but have never sold a business in their life. And extremely different company, growing at triple digits, obviously taking on a lot of debt. But during this sort of SaaS apocalypse, they're acting like a private equity business, buying up these companies, but not to flip them, to hold them and bring in the cash flow.
Interesting.
Yeah.
So sort of like Thoma Bravo, almost a little bit, but not really.
Yeah, it's a little interesting, but expensive. People obviously that see them making a name for themselves in very quick succession. So yeah, they're like a $25 billion market cap when maybe you could see some comps being probably half that. But they started in 2013 with their own capital. So like it's pretty wild to create a $25 billion company just acquiring businesses. They have not created a thing themselves.
Absolutely. Good for them.
Yeah. But what's called? We talked about Uber, AppLovin. There were a couple people saying some things in the chat. Mercado Libre.
Another one of those. I'll go right back to our CapEx conversation where the right thing to do is not always what public market investors want. And Mercado Libre is in aggressively build out their competitive mode and make sure C Limited and Amazon don't encroach on their market share in Brazil. Make sure they're one of the largest financial institutions in Latin America. Make sure that their loyalty program has as many perks as anyone else, and the fulfillment network is as fast as anyone else. Right now, that means a lot of pressure on the bottom line, which is why the stock has been under so much pressure over the last really 5 years now. But I think I think it's an amazing company, and I think there's going to be, I don't know, there's no guidance here. You need to be super patient, and you need to be okay with a leadership team that does not care about what public investors want. and that's going to do exactly what they want to do, and that's building a 100-year company. But there's going to be a year or a quarter where they pull back just a little bit on all the CapEx and all the OpEx growth. And it's sort of like Amazon. Like, they are so in control of their P&L. Like, their profit growth is going to explode at some point, but who knows when? And they are going to spend for as long as they feel like it's the right decision to spend, which I don't think is going to end at least in 2026. So buckle up and zoom out if you want to own this name for sure.
Yeah. In that same similar vein, I don't know if you, well, I do know that you look heavily into Nubank, but if you also look into DLocal at all.
I don't look as much into DLocal. I love big, safe, and boring when I'm venturing outside of the USA.
Sure.
So Mercado Libre, Nubank, C Limited, like those kind of names, really just the Moat. I don't like diamonds in the rough when you're ex USA. I really go for comfort there. But a lot of people love that name. The growth. It's like a rapid grower, a little bit of gross margin pressure, but making up for it with OpEx leverage kind of thing.
Yeah, a lot of bit of gross margin pressure, but
okay. I mean,
definitely,
Shopify made it work.
You know, TPV I think is growing at like 93%. So
Shopify made gross margin moving from almost 60% to 40% work very well. So you can build a great business while accepting that. So not a deal breaker.
Yeah. No. I know you have some comments about some retail apparel names, but any thoughts on Nike?
Yeah, if a swing trade, maybe I have stopped kind of looking at the name and following it as a couple quarters ago. The only one I really paid any attention to at all is on running, or on holding, I guess is the company enterprise-wide name. But yeah, I don't like apparel as an investment opportunity. It's definitely a byproduct of bad picking in the past. I mean, I owned Lululemon a couple of years ago. I think I lost 30 or 40% there. Got out what felt like a bottom, and sure enough, it was not a bottom. Hopefully, Michael Burry makes some money on that at some point. But he's got a movie and Substack and whatever, so he's fine. I shouldn't worry about Michael Burry. But yeah, clothing is really hard. I mean, you have to figure out how the minds of an 18-year-old kid works, and how their preferences change. Like, people saying 6'7", whatever the hell that means. Like, those are the people that you have to understand. Like, that you have to know when they like a button in a certain place, or a collar, or this color is not in vogue anymore. And if you mess up one time, there are no switching costs. Like, you can just walk to the next store, right next door, and buy a different t-shirt. And if the economy is not amazing, the very first thing, the easiest thing to cut out, besides maybe Starbucks coffee or something like that, is buying a new t-shirt and stretching out the life of your existing t-shirts. Not to mention the fact that it's not like a cybersecurity industry or data infrastructure industry where you're going to get sector growth well above GDP. Like, you're not getting that either. So what you get is these really hot brands that come and go all the time. I mean, you can throw like energy drinks into there too. You can throw a lot of different kinds of consumer discretionary models into there. But these hot brands come, they get influencers to pick them up and partner with them. They have really long store growth runways that they can open up all over the country, and traffic growth looks amazing for a while because their brand awareness is really low, and they can spend a lot on marketing and reach a lot of new people very easily, so very efficiently find new ways to grow. But at some point, brand awareness closes in on 100% or wherever the ceiling is. Store growth slows down, and then you are at the mercy of cyclical tailwinds and headwinds that ebb and flow. You're at the mercy of that 18-year-old person who knows what they're going to want from you in a month. And if you guess wrong, you're going to have so much inventory on hand that nobody wants. You're going to have to discount like crazy. Margins are going to suffer. Your brand quality is going to suffer. So On Running right now is doing the best out of any of them in terms of avoiding the temptation to flood inventory with wholesalers and maximize revenue growth at every turn. But even then, it's just best house, bad neighborhood. And I like other neighborhoods better for investing.
Yeah, that's really interesting. The only one that I've really played in the past, like Aritzia, but they're probably not at the sort of 100% brand awareness quite yet. I think they're sort of building out, and they're in specific pockets of Canada and breaking into America right now. So that was many years ago. I wanted to also touch on SoFi.
Okay. What's that? No.
Yeah, I don't cover that name. Current thoughts on SoFi in this rate environment?
Doing everything they need to do to make sure when macro backdrop cooperates a little better and they can macro backdrop is really not that bad right now. Like they're performing very well. It's just sentiment is not very good because people are kind of fearing more rate hikes and what's that going to do to forward guidance. But they already have more hawkish policy in their forward guidance than what's currently expected. I don't think we're getting more than a couple hikes this year. I'd be pretty shocked. So this year should look pretty good. Next year should look pretty good, barring some macro collapse, which is always possible. But you probably need some kind of rate cut or dovish pivot from the Fed to really have the stock price moving in the right direction. But while all that happens, the company's moving in a great direction. So to me, it's just kind of coiling spring. Like members compounding rapidly. Cross-selling is reaching some pretty impressive inflection points as of last quarter in terms of product growth ramping more quickly than member growth, which is that's the flywheel working. So everything that has to look underwriting precision's great. They're doing it. People are not happy that they are shifting some of the lending demand back away from lending platform business to their own balance sheet. But why'd they raise all that money if they're not going to stash really high margin loans on their balance sheet and start making a lot more net interest income from them to meet their 2028 targets and go from there, and to create all this visible revenue like they talked about in the earnings call to fund all these growth investments that they have. So maybe the stock doesn't work in the immediate term. Maybe we don't see it go back to 30, 35, or 40 in the next 6 months or wherever it topped last time. But as long as they keep doing exactly what they're doing and just nothing needs to be fixed, maybe the tech platform could look a little better, and then they could start delivering some big wins there. But from an overall company perspective, keep delivering that top line compounding, keep delivering that margin expansion, even at a slower pace. Doesn't really matter. In my opinion, if they're going to show these growth investments working so well, and the stock will work eventually. I don't know when. I don't have a crystal ball. I know you're not asking me to, but I know some people would love me to give them a date. But company performing very well. Stock maybe not going to get credit for it immediately, but it will get credit at some point. They are putting themselves in a position to be rewarded when sentiment for the overall industry improves.
Well, actually, that goes into my next question, which was, what day do you think it will go up? No,
what day does it reach an all-time high?
I do have two questions. So first, what did you think about whenever we were, sort of $30, $32 back then? Was that nearing some form of overvaluation or fair value based on your assumptions? Go ahead.
I guess it's people will roll their eyes, but I have fortunately a real-time feed of primary source transactions that from the newsletter. So I was trimming pretty meaningfully when it was crossing 30 last time. Not because I thought that's it, like that's the ceiling for the company. I don't think it's even remotely close to the ceiling for the company, but it was getting to a growth multiple that was more fair, and it had moved from a point to being grossly undervalued to more fairly valued. And I was buying hand over fist when it was grossly undervalued, and it had gotten to a point where it was as big as these other big bellwether anchor holdings in the portfolio. The profit, it was up a lot, so just kind of harvesting some profits and taking advantage of that opportunity with risk reward maybe not as good as it was when the stock was at 4.5 in 2022.
The next thing, and Shy posted about Piper Sandler initiating an overweight rating on SoFi, like $22. How, like this? I know you're not answering for Piper Sandler, right? But you've read a lot of these reports. Why is it that you might not have seen this one, but they, I think, guided or modeled out for 22% revenue CAGR through 2028 on a 27% adjusted EBITDA CAGR? Why do they have such conservative models versus what SoFi has said themselves? Like what gives them credit to do that?
I don't think sell-siders are willing to look out a few years in the future for a company taking a lot of credit risk and not bake in some kind of probability for what happens if macro sucks. Like we need to bake in some kind of margin for safety for if unemployment crosses 5% and SoFi needs to pull back on loans. And if that happens, we don't want to drastically change our models and look like idiots. So it's better for them to be a little too low in their forecast than to be too materially too high. So to me, it's covering their behinds and making sure they don't look too wrong if ugly parts of macro unfold, and they're okay looking a little wrong if SoFi does meet their guide. So it's just a lack of an understandable lack of willingness to kind of forecast with 100% certainty that the macro outlook that SoFi has embedded in that multi-year guide is for sure going to come to fruition.
I'm going to switch it up on you a little bit because I want your opinion on this name. I've never been a fan of this company. I'll preface it that way, but I don't know your response. What are your thoughts on Netflix?
Oh, this is why I have so much respect for Spotify. Not to change the subject a little, but I'll get back to it. I promise. And maybe for a third company like Axon. Well, Axon's biggest competitor is Motorola. They have to out innovate Motorola, and I have a lot of respect for Motorola. Great company, but that's doable for a company like Axon.
They've been out innovated before.
Yes, company like Spotify has to beat Apple, Amazon, and Google, and in a field that entails offering the same content with a different interface, and hopefully having more of that content, but basically having a very similar product and tying it together in a neater bow with maybe better personalization algorithms and that kind of thing. That's really hard to win in, and they somehow are figuring out how to win. I think that is the exception to the rule. I mean, think about Teladoc and what happened to them when Amazon decided to snap their fingers and get into telehealth. I mean, these big companies that don't need to make any money on a specific product are very hard to win against in sustainable fashion. And right now, Amazon, Apple, and Google are spending a ton of money on content and are pushing very hard into streaming. And they're coming out with a lot of great stuff. I mean, my social circle, anecdotally speaking, talks a lot about shows from Netflix, but now a lot of other streaming platforms. And it used to be all Netflix, and that used to be all anyone talked about. And that's not true anymore. So between that and the fact that they can outspend Netflix, and they haven't built decades of really close and tight relationships with creators and artists that maybe don't want them to lean in as aggressively to AI-based content creation because they feel a little bit threatened that you're going to maybe try to replace us. So Netflix, I think, also has to be a little more careful with replacing costs with compute. And I don't think Amazon and Apple and those companies need to be quite as careful. I think that's not as big of a factor as the reality that Apple and Amazon and Google can spend an absolute fortune and a half compared to anyone on the planet and operate at razor thin margin and make it make sense from an economic point of view. Netflix has to make their EBIT margin from their streaming library, and that's not true for these other companies. So I don't love the investment. I love the company. I think it's an amazing story, but I think maybe, I'm not the days of dominant market power are over. I think that's pretty clear. That's not required for them to win in such a massive field, but I don't love the investment case right now.
Yeah, but on the other hand, and this is speaking from someone who I don't want to share of, Netflix, but it's not like we've been in some stagnant high price while the, bear case is potentially building. The stock is also quite down. Does that change the potential thesis that, hey, you know what, this stock might not be as dominant as it once was, but the valuation is reflecting that, or it's still not worth being touched right now?
Absolutely. I think it's a lot more attractive at 22 times earnings. It was at 50 times earnings 12 months ago. So yeah, or 14 months ago. So yeah, definitely that helps a ton. I mean, cheaper companies don't have to perform as well to make it make sense. So yes, that's never my favorite part of a bull case, as I know you are of the same opinion, but that does help a lot in terms of risk reward. Cheaper means that you can perform in more underwhelming manner and not be punished. So yeah.
And to be fair, I still own Netflix, and I don't know how many years I've said that I was going to stop paying for Spotify because I pay for YouTube Premium. So I have YouTube music for free, and I still haven't done it. So I don't know. There's something there that's sticky, or I'm too lazy to switch. Who knows? Another company, and I don't know if you cover this one, but Adobe.
I don't know a ton about it. I think content creation, that's pretty low hanging fruit for AI. Vibe coding use cases for that kind of thing are more straightforward than data engineering or analytics or things like that. But at the same time, vibe coding and AI does better when you have a ton of data and a ton of experience and a ton of edge case mastery that can only be developed from operating at scale for decades, and that's Adobe. So the onus is on, or it's up to them to kind of out innovate the disruptors, and they have I don't know enough to offer a strong opinion on whether they're able to do that. But I don't think that maybe while I don't think that AI is a death sentence for them, but I do think it's a pretty pressing risk that they need to respond very well to.
Yeah. I don't know if there's any others. If there's any in chat that potentially we missed, we talked about a lot of the semi names. Palantir was one that I definitely want to touch on. Uber, Netflix, SoFi. Talked about a lot of LATAM. Is there any names that potentially we didn't talk about that you do want to make sure that you do say something about because maybe people aren't paying attention to?
No, that was a pretty fun whip around. I think. Yeah, no,
it's all over the place. There was no wasn't alphabetical or anything.
Yeah, no, that was fun. I love when there's no script and kind of just
really quick.
Yeah.
Can I ask you about memory?
Please. I would say aside from neoclouds, that is another one of the most purely directly tied to AI supply scarcity as you can possibly think of. Have had some headlines about Nvidia maybe figuring out how to operate the new Rubin platform with lighter HBM. More companies like Cerebras coming in and maybe changing memory architecture and where it's actually processed to make it more efficient and kind of like that ASIC versus GPU debate that's been happening over the last couple of years. That's sort of what's happened. Maybe not a great comparison, but on the memory side, just different architectures for where that memory is stored and processed that are becoming maybe more popular and maybe could take some use cases away from HBM that's being used for pretty much everything. Then you have Apple that's trying to figure out how to maybe get the green light for some Chinese supply because I mean that's their middle finger to Micron basically. Yeah. But in fairness, Micron is putting their middle finger up to Apple right now because for years and years when there were supply gluts, Apple like really dug in on demanding price concessions and just being tough on Micron and making a positive gross margin, even 1%, impossible to maintain for a while. So they're doing what they're supposed to be doing. I mean, they have the market power that's shifted aggressively, and they should be taking advantage. It's another one of those. Do you buy it here? I don't know. I personally would probably go for something like Taiwan Semi or Nvidia over a Micron or someone or SanDisk or someone like that, just because I like it big and boring. Especially when you're exposing yourself to a cycle that has so many unknowns and so little predictability on timing. Because maybe aside from Oracle and the neoclouds, this is the memory names will be blown up the most aggressively whenever this ends. Again, that could be in 10 years. I have no idea when that's going to happen. But I do know if this cycle looks at all like any other cycle we've ever had, that there will be a point where we have too much memory. There will be a point where pricing pressure starts to kick in a little bit and margins start to contract a little bit on the memory side. And then it will go from slowly and then kind of all at once type deal. So I don't want to be in memory because I don't have a great sense of when that happens. And I don't have a great idea of the perfect sign to look for getting ahead of when that happens. But I do think if you are an AI infrastructure bull, that's a more aggressive way to play it. If you're looking for that higher risk, higher reward kind of mentality, which sometimes I shy away from a little bit in certain situations. Candidly, I take the ETF route for AI infrastructure exposure just because there is a lot of change constantly happening in the industry, and I mean, Broadcom was the ASIC design king for a year, and now there are a lot of new competitive pressures emerging from Marvell and other companies that are maybe taking pressure away from ASIC. So just these constantly moving chess pieces in AI infrastructure. Not to mention the fact that mega caps are pushing so hard to do more and more on their own. So I love the ETF route just because I feel like the ETF exposure route is me saying, I don't think this cycle is over, but I don't know who the winners from today are going to be. And I want to get paid no matter who that is. And I'm okay with getting paid a little bit less than if I guessed the right winner in this area.
No, I mean, that's a genius strategy, right? And one that most often really works is like, I know that there's going to be more spend. I don't know who the checks are being written to, but it's going towards infrastructure. And that's of course, that makes a lot of sense. You know, I probably would have done better this year instead of just betting purely on Nvidia if I would have saw some of that AMD benefit.
Well, 5-year chart. That's all. That's all I'll say.
Yeah, no, five year. I'm good.
You're doing well. Tanner's doing well. Don't you worry about Tanner, listeners. He's doing great.
Well, you know, still worry about me.
Worry about him the appropriate amount. Not too much or too little.
Stock market nerd, Brad Freeman, brother, thank you for jumping on. I don't know if there's something that we didn't cover. I feel like, you know, your coverage is very extensive. But we kind of did do a lightning round. We kind of went through a lot of things very quickly. But SaaSpocalypse, how you feeling about that? Buying opportunities?
It's definitely, I mean, it's been a fun couple months of sticking your neck out for some of these companies and having them rebound. I think we've gotten to a point where sentiment has the extreme unconditional, unanimously negative sentiment is over. And I think, Atlassian getting rewarded for a great quarter, Workday getting rewarded for an M&A rumor, these companies enjoying a ton of multiple expansion, ServiceNow, I think 30 or 40% off the low. So I think we are at a point now where it does matter if you are a winner or a loser. And or we go up or we go down another 50% from here. And as long, like we're at a point right now where if markets just chop around a little bit and we don't get another aggressive sell-off or another aggressive move higher, I think it's going to become more discriminate in terms of this company had a good quarter, so that doesn't mean every single software company in public markets gets to go up 10% the next day, or this company had a bad quarter and vice versa. It doesn't mean every company gets unanimously sold off. So I think results will start to matter more. The durable themes of who's going to win in the AI age and in the app layer and data infrastructure and things like that will start to matter more. And you'll start to see even more divergence in performance from stocks of companies that are still nearing their 52-week lows and probably lower to go, and companies that have aggressively bounced back and probably higher to go, even at higher multiples. So maybe more of a stock pickers market versus a few months ago where I think you could have thrown a dart at any company in IGV and been rewarded just because everything had gotten so unfairly punished.
Now, I want to ask you a little bit of a question. I think that your style of investing is so out of the the popular well, I mean, obviously you're buying popular stocks, but I feel like a lot of what goes really viral online is like sensational momentum driven picks, and I think that you're definitely focused on artificial intelligence, but still from a fundamental investor point of view, you're focused on free cash flow, actual growth of the companies. Are these companies getting stronger? I don't know if you'll take that as what you like to do fully, but does your career ever advance out of Substack or writing articles? I'll just get to the question within the question. Are you ever going to manage money?
Oh, I don't know.
I feel like the way that you invest is the way that I think of money managers investing capital, rather than being sensational.
Well, I appreciate that, because the business is formed to give people access to good info and good ideas for a price that isn't ridiculous. And doing so in a way where I'm not directly touching money, but I do think so, and I don't think it's going to be for a while, just because that I mean, I'm 29, so this is, I think, year 6 or something like that. I need more time to show myself and prove to myself that my ideas are better than average, and I can create value for people by charging them to touch their money. And I think I need maybe a solid decade of that would be great. So halfway there kind of deal.
Yeah.
But as of right now, I have a lot of fun with the newsletter Discord combination, and now mixing in some more podcasts. But yeah, I would definitely, I will in the future when it is painfully obvious to me that I deserve to, which I will be the last person to decide that, and everyone will be rolling their eyes at me in the entire way. I get asked pretty frequently, and so and that's very flattering. If you're a subscriber and have asked me, I really appreciate it, and I'm sorry that my answer is no right now. It might be yes in the future, but yeah, I want to show the world and myself that I am great at this, and I don't think I have done that for a long enough period of time to warrant charging people for touching their money.
Well, Brad Freeman, stockmarketnerd.com. Appreciate you coming on, and as you explore more podcasts, joining mine in front of my audience. I think everyone really enjoyed that, so thanks for coming on.
Please, yeah, and Tanner and I have a weekly thing too, so we'll do a little switcheroo and have you on, and did I say Tanner and I have a weekly thing?
You did. I was gonna.
And I have a weekly thing. So we'll do a little switcheroo, and there we go. There, names are. But
you used to have a weekly thing.
yeah, man, made it almost an hour without any any slip ups, but had to have one. So yeah, this is not AI, so now people know it's not.
Yeah, exactly. Well, thank you, brother. Appreciate you jumping on.
Have a wonderful rest of your day, and talk soon.
All right. So yeah. That was the great and powerful. He doesn't want me to call him that, but that's what he is. He's the great and powerful Brad Freeman. I think Bsov in chat was the only person that guessed. They said like the stock market guy, Michigan guy. I was like, that was the one person that guessed who was coming on. Brad is the real deal. Yeah, I should have. My introduction of Brad was bad. I should have told you guys who he was. He's definitely extremely popular on X, and has his own. I don't know if it's actually a Substack, but it might as well be a Substack, of like a article subscription type thing where he covers those names. Okay. Yeah, we used to have a weekly show together, me and him and Evan. Yeah. Okay. That was the great and powerful Brad Freeman, but we're not done with guests today. We have potentially some other names here. So we'll see if our next guest is going to join us. What is Trump talking about? Just so I can make sure that we're good there. Is he... Do we need to listen to what Trump is saying right now? Well, he's not live right now. Oh, you know what? We're going to focus on this. President Trump delivers remarks with technology leaders. It's not live right now, but that should be quite big. We have been sitting in this paused state. Here, let me just make sure the next guest knows that I might be ditching him. If Trump goes live at 3 or something, that would be amazing. This is what I'm currently seeing, so. Okay. Trump's going to backstop AI with entire U.S. economy. Hopefully, but this is what, like, right or wrong, the things that I've always said about investing, like one of my key principles is don't bet against the administration. The administration says that he hates solar, and you know they're going to drop subsidies for EVs. Those are not the areas I want to be invested in. And if they say they want to backstop artificial intelligence and they want to do full focus in investment into artificial intelligence, like, you know where I'm going to be. I'm going to be investing in those areas. This guy said, hopefully. Yeah, because I've got all my money there. I'm here for me, man. Okay. Vlad is there. Do you guys know when it's expected to be live? Because they've been live now for 40 minutes. It's still not started. So that type of timeline is not getting me super. Nvidia has discussed investing in AI data supplier as part of a funding round that would value the startup at $20 billion. Is this for Mercor? Yeah, AI data supplier Mercor. Mercor hires specialists across fields such as science, law, and finance to train and evaluate AI models. Their work generates higher quality data that model developers use to improve performance on complex, specialized tasks. Nvidia paid Mercor tens of millions of dollars last quarter and used data to develop its 2 latest Nemotron models. Several Mercor employees are now reportedly focused entirely on Nvidia-related work. The relationship is growing as Nvidia puts more resources into Nemotron, its family of OpenAI models. Okay. What did you think of Nubank's Q2 numbers? We did a full review. I think it's on the second channel. I need to go through and review that just to be sure if Marshall put it up there. But really, really excited about Nubank. They've constantly done extremely well. I've been a shareholder in that company for what's coming up on 4 years, 3 years and 8 months, something like that. But if all goes well, I'll be investing in that company for 10 years. A true tenure. A tenure. What's up, Tanner? What's up, Nick? How you doing? Okay. Trump's still not live. That's what we're waiting for right now. And maybe I can pull this up just so people know where we stand. Oh, wow. What great. I was literally just pulling it up. Holy.
It's a serious group of people here. If you're into the
okay, one sec. Let me adjust that audio. That's extremely quiet. Oh, wow. That can't be the. It's like legit.
Today, we're delighted to welcome some of our nation's brightest minds in finance, crypto, and technology ahead of the first ever meeting of the CFTC's Innovation Advisory Committee in Washington, D.C. This is a group of very smart people that are on a committee to recommend what we do. Right, Paul? They're going to be telling us a little bit, but I think Paul knows maybe more than anybody. He's doing a great job. We're all happy with Paul, I think, right? He's been absolutely fantastic. Crypto markets and the prediction markets and conventional finance to decentralized finance. The people in this room are ensuring that the future of commercial markets is pioneered and perfected right here in the USA. We're fighting a lot of other countries to control these markets and to have these markets and to profit and all the jobs and everything else created. And we're doing well. We're leading in every aspect, including AI, and we're leading by a lot. And we want to keep it that way. I want to thank the chairman of the Commodity Futures Trading Commission, Mike Selick.
Okay, they finally
for his
turned it up.
Tremendous leadership. And come here. Thank you, Mike. I didn't recognize you from so close. And thanks as well to a very special man, a man that everybody respected for a long time. Yeah, he's a man I wanted to do this job, head of the SEC. Chairman Paul Atkins, who's also doing an outstanding job in everything else he touches. He's doing a lot of things for the country. So I want to thank you very much. Great job. Thank you. Thank you very much, Paul. We're also pleased to be joined by Executive Director of the President's Council with advisors with the digital asset. All of the digital assets are all put into one, Patrick Witt.
and many other top industry leaders, including Coinbase. Where's Brian? Brian Armstrong, CEO. He's one of the greats. Where is he? Where are you? Oh, you look well. You get much younger. You look good. CEO of International, an intercontinental exchange, Jeff Sprecher. One of the things, a little thing called the New York Stock Exchange. He owns a thing called the New York Stock Exchange. Quite a nice asset, right?
Yes, it is.
CEO of NASDAQ, Adina Friedman. Thank you very much, Adina. Great job you're doing. CEO of Robinhood, Vlad Tenev. Thank you, Vlad. Nice to see you. And CEO of Kraken, Arjun Sethi. And thank you very much, wherever you are. Thank you very much. Great group of people. We also have some others here that we wanted them. It's where's Mike, co-founder of CEO of CTO and president of BitGo, which is a big deal in the world of that thing, that little thing that's happening out there. And Brad Garlinghouse, CEO of Ripple. Brad, thank you very much, Brad. Sergey Nazarov, co-founder of Chainlink Labs. Thank you very much. Good, Sergey. Good job. Arjan, you're here. Arjan? I'm still here. You're here? You haven't left? Peter Smith is here, and Tyler and Cameron Winklevoss are tremendous people, tremendous investors, brilliant people. Chris Dixon is here. And I think I've sort of got anybody I didn't mention, by the way. Pretty much got the whole group. Good. They gave me 4 sets of lists, and that's always a little complex. You never want to say one more than 3 times. Under the crooked Joe Biden administration, the spirit of innovation that built America was under serious attack like never before. And nowhere was that more true than crypto and other new financial technologies, where we were going to be taken to the cleaners by China and other countries. The radical left tried to crush these developments with crippling regulations, brutal restrictions, weaponization. They used weaponization, political weaponization, and constant targeting that drove innovation overseas. And they wanted to drive it out. And at the end of toward the end of the campaign, if you remember, they decided they liked it very much because there were over 100 million people that were liking Trump a lot more because I was in favor of it. They were against it, and they became very much in favor of it. But by that time, it was too late. And besides, those days are all over. That was a terrible period of time for a lot of very good, very honorable financial people. On day one, we fired Joe Biden's rogue SEC chair, Gary Gensler. I think we like Paul better. Do we agree? We'd like Paul better? Number one, he's smarter. He's also smarter, by the way. But we fired him. We got him the hell out of here. We terminated the so-called Operation Choke Point 2.0, which is what the name of their operation was, weaponization. And we ended the war on crypto once and for all. And it's been booming. It's been doing big. And nobody's been able to break in. China would like to break in. They're still trying, but they have been able to. I signed a historic executive order banning any attempt to create a central bank digital currency. We launched Project Crypto to modernize rules so that our financial markets can move into blockchain technology. I established the United States Strategic Bitcoin Reserve, making Bitcoin a permanent asset of the United States Treasury, which has turned out incredibly well. I also created the United States Digital Asset Stockpile to hold custody of all other digital assets, and that's exactly what it's done. It's been amazing. 1 year ago this summer, I signed landmark legislation known as the Genius Act. I named it after myself. I didn't want to use my name, so I just called it the Genius Act, paving the way for widespread adoption of dollar-backed stablecoins, and that's worked out very well. Every single American benefits enormously from our country's status as the financial center of the world, and we want to keep it that way. We're leading by leaps and bounds. We've gained so much in the last 16 months like nobody can believe, actually. Not only that, but we have more money being invested in the United States than any country at any time in history. Money's coming in by the trillions. Our nation's economic dominance drives trillions of dollars in investments, creates millions of jobs, and expands access, credit, and capital so that every citizen has a chance to achieve what we now hear a lot about, the American dream. Young people are looking for the American dream. They weren't thinking about that 2 years ago. New financial technologies are extending this American dominance into the 21st century, and that's why we're focused on creating a clear regulatory framework for pioneers and builders like the people that are with me here, so that they can do business with confidence on American soil. They don't have to go to other countries to do their business. We're ensuring that America remains the undisputed leader, not only in Bitcoin and crypto, but also technologies like prediction markets, artificial intelligence, and much more. And we're leading in every single one. And I will tell you, the AI, the artificial intelligence, we're way ahead of number two. Number two is China. And I never want to underestimate China, but right now we're way ahead. President Xi's coming on September 24th. We look forward to it. We'll probably be talking about AI and a lot of other things, but we're doing tremendously well, largely because of people and some other friends of ours that are on the board. And they'll be here in 2 weeks, I understand. In May, Chairman Selig authorized the first ever true Bitcoin perpetual futures contract on a CFTC registered exchange, first time. I understand that Mike is also working to bring hyperliquid into the United States in a fully compliant and legal fashion. He's working very hard on that. We would really like to see interest rates come down. You know, in the old days with interest rates, many of you are too young to know this, but when we announced good numbers, interest rates would go down. And the theory was because the asset value became so good, it became so prime. But now when we announce good numbers, which we're doing all the time, they keep driving the interest rates up because they're so afraid of inflation. And they shouldn't be. They should allow interest rates to go down. When you announce good numbers, you shouldn't drive them up. They keep thinking that we'll drive them up to stop inflation, because success and growth does not cause inflation. Other things cause inflation. We inherited the #1 inflation ever in the history of our country from Biden, and it lifted prices and everything else, and we're getting them all down. But interest rates should be allowed to fall with the success of our country, not rise because of the success. But we're also on the very beginning of a revolution in fictional and financial. You take a look at some of the things that are being done on a financial basis and the financial technology that's the potential to create more jobs, opportunity, and wealth for all Americans. And that's what it's doing. It's creating jobs and great wealth. And I think that can't be better seen by the stock market. So we've had 80 in a short period of time, a year and a half. We've had 80 days where the stock market hit all-time highs. I haven't looked today. I don't know. Maybe I shouldn't look. I don't want to look. But I hear it's good. But we've had 80 days, Jeff, where the stock market has hit an all-time high, and nobody's ever seen anything like that. And I think bringing it down to another level, and maybe a higher level from the standpoint of importance, 401ks have hit record highs on almost 40% of the time that I've been president of the United States, and that affects tens of millions of people. The 401ks are at record numbers. So 2 years ago, our country was dead, and now our country is the hottest country anywhere in the world. There's nobody close. No other country is close, and every country will admit it. So now we need Congress to take the next step by passing the Clarity Act, a fair version of the Clarity Act, and this landmark structure legislation. It's a very, very powerful structured legislation, which will keep us ahead of China, keep us ahead of everyone else. Will open the door to the next wave of innovations and innovators. So I'd like to ask Chairman Selig to say a few words and a little bit of the details about what we're doing, and then we'll follow it up with Chairman Atkins and Coinbase CEO Brian Armstrong, Intercontinental Exchange CEO Jeff Sprecher, Robinhood CEO Vlad Tenev, and Kraken CEO Arjan. So we have that all set, and let's get going. And you know what? If you want to speak for a very short period of time, that's okay too. Yeah.
Thank you, Mr. President. It's an honor to be here with you and this exceptional group of business leaders. Thanks to your leadership, the era of political lawfare, debanking, and regulation by enforcement is over. Innovators like the people in this room are welcome to the White House, not railroaded to the big house. And the new frontier of finance is being built right here in the United States of America. From day one, this president has been clear. America will not fall behind and allow other countries to take its place as the greatest country on earth to build a new technology, operate a business, and invest for the future. The world will run on the backbone of American technology. Under President Trump's leadership, we've codified the Genius Act, established a strategic Bitcoin reserve, drawn a clear line in the sand between crypto securities and commodities, launched the first US crypto perpetual, and protected the rights of software developers. We've exiled Gary Gensler, defeated the anti-crypto army, and made the United States the crypto capital of the world. I'm proud to be working with Secretary Lutnick in the Department of Commerce as well to make America the compute capital of the world. This may be the most important commodity of our day. Some call it digital oil, and America needs to dominate these markets to win the AI race. We've also protected federally regulated prediction markets from rogue state attorneys generals like Letitia James, who seek to nullify federal law and drive these markets offshore to unregulated and foreign venues. American dominance in the technologies that will define the future remains unmatched. We are truly in a golden age of American innovation. Now, the United States has a choice. We can either write the rules that define the next generation of financial markets, or we can let other countries write them for us. With Congress advancing the Clarity Act towards the finish line, we stand ready to implement the bill once the president signs it. But we'll use every tool available to move the president's pro-innovation agenda forward in the meantime. Tomorrow at the inaugural meeting of the CFTC's Innovation Advisory Committee, I look forward to sharing more details on our regulatory path forward. A path forward that provides greater certainty for innovators while reinforcing confidence in our markets for decades to come. This president has assembled an extraordinary team of entrepreneurs, builders, investors, and business leaders advising in government, like David Sachs, of course, and Patrick Witt. This real-world experience has already brought valuable perspectives into policymaking, and it will continue to pay dividends for the American people. Innovation depends on regulatory clarity. Clear rules create confidence, confidence attracts investment, and investment creates jobs, strengthens our markets, and keeps the world's best talent building here in America. Mr. President, thank you again for your leadership and for making American innovation great again. The work we're doing now to shape the future of our great nation will do measures for decades to come. Now, I'm honored to introduce the most pro-innovation, pro-free market SEC chairman in America's history, and it's not Gary Gensler, of course. It's Paul Atkins. So, Mr. Chairman, please.
Well, thank you, Mike, and thank you, Mr. President, for having us here today. From day one, you've made our nation's financial dominance and innovation job one. We at the SEC are delivering on your agenda. We're making IPOs great again, to continue on your theme, by cutting red tape that discourages companies from going public. Under your leadership, Mr. President, the IPO market is booming. Since Inauguration Day, 583 companies have gone public, and that's up 75% compared to the final year and a half of the Biden administration. And those companies have raised an impressive $208 billion, and that's nearly 4 times the amount raised during the final year and a half of the previous administration. So that's just not incremental progress. That is a turnaround. You've committed to making the United States the crypto capital of the world. And yesterday, the SEC, I'm proud to say, took another significant step to deliver on that. Our proposal, the crypto assets rule, would provide crypto entrepreneurs like those here in this room and job creators the certainty to raise capital in the United States using digital assets. This action is consonant with our belief that the most important priority is for Congress to send the Clarity Act to your desk for your signature. And the SEC is doing everything we can to support that work. So thank you again, Mr. President, for leading this nation to ensure that we continue to have the strongest markets in the world, to reshore innovation, and to welcome, yes, a whole new generation of investors through the Trump accounts. So under your leadership, we will make sure that the greatest advances of the technological frontier are right here in America. Thank you very much.
Well, this morning I was thinking back to the 2024 campaign where the president, I think, very astutely recognized there was millions of voters in the United States who felt disenfranchised by the prior administration. And he made a commitment at that time to make America the crypto capital of the world. And within weeks of taking office, delivered on that promise. And it started first with this executive order, which came out ordering the agencies in his administration to take steps in this direction. He shortly thereafter appointed two of the most competent and pro-innovation regulators anywhere in the world, Chair Selig and Chair Atkins, and of course fired Gary Gensler. There was that big applause line at the Bitcoin conference, which was powerful. And of course, the Genius Act was another milestone just in the past year, along with the Strategic Bitcoin Reserve, et cetera. And just this week, I have to commend Chair Atkins for publishing this new rule that allows crypto projects to raise capital in the US for the first time. There's clarity on that. And Chair Selig, we're excited to attend the advisory committee meeting tomorrow to make progress there. So an incredible amount of progress has been made. And I think what's most important next, of course, is this September 15th vote that we have with the Clarity Act. This would make all of the progress that this administration has made durable into the future, so it could survive for decades and decades to come. And make no mistake, there are folks out there who they want to see this legislation not happen, right? Maybe some of the big banks don't want the competition from crypto companies. Other banks are leaning in and have endorsed it, which I think is really powerful. And so if we all come together, I think we can get this bill over the finish line and hopefully get more than 60 votes come September 15th. Thank you.
And it's very bipartisan, I would say. So very much.
That is true.
A lot of Democrat support.
There's hundreds of pages of changes that have come in from the Democrat side as well. It's a true bipartisan compromise. And yeah, it's a great it's a great work product. So up next, I think, is Jeff Sprecher.
Sorry.
Thank you. Mr. President, I just wanted to tell you that that your trade policies of fair trade to bring back jobs and businesses from overseas, your energy dominance policies to fuel the next generation of technology in the United States, your big, beautiful bill that created incentives for investments has led to the records that you're hearing about in our stock markets, the record number of IPOs. And as you know, from working with my wife who works on private businesses, there's a record number of business formations in this country right now. Sure. So we're here to talk about how to evolve regulation so that we don't impede that progress. But one of the things I can tell you about the New York Stock Exchange is that it was formed at the time of our country. And so it, for 250 years, has been subject to every single financial services regulation that has ever passed in the United States, bar none. And so one of the things that I'm so thankful that you've done is put two really strong chairs in these seats and ask them to go through past legislation, regulation, and figure out what we can get rid of that no longer serves the interests of this country. And for that, I really appreciate that on behalf of the New York Stock Exchange.
Thank you very much.
Thank you, Mr. President.
Mr. President, thank you for bringing us together and for your work to ensure the next generation of Americans has a stake in the country's economic success through the Trump accounts and many other things. Thank you also to Chair Selig, Chair Atkins, your administration, for the work underway to strengthen American capital markets and expand opportunity for all Americans. If I had to sum up Robinhood in one word, it would be ownership. Broad ownership is essential to a free, stable, and prosperous society. That belief has shaped pretty much every product we've built, from commission-free investing to 24-hour trading, and now outside the United States to tokenization, which we're using to expand ownership of American assets to people in more than 120 countries. Yet this innovation is reaching investors abroad before investors here back home. And the opportunity goes far beyond public markets. Tokenization will open up markets that have long been out of reach, including private companies. Today, too much economic value is being created before ordinary investors get a chance to participate. Expanding ownership also requires protecting investors. Innovation and investor protection aren't opposing goals. America became the world's capital markets capital by doing both, and the chairs here understand that. American companies are building this technology. American markets are powering it. American assets are also at the center of it. American investors should not be the last to benefit. We look forward to continue to work together to expand ownership, build the next generation of capital markets, and ensure America leads the way. Thank you.
Great job.
Arjun.
Hello, everyone. I was thinking about what I was going to say today. Most of the time, I don't speak too much, but the first time I met the president, he said, "What does your company do?" And I said, we're a startup. We move at warp speed. And the first thing he said is, "Why not at Trump speed?" So we started acting that way. Look, our mission at Kraken isn't about Kraken. Brian created Coinbase. Vlad here, you have ICE, NASDAQ. They created the world markets. And all we're trying to do is make sure that everyone in America has the ability to be able to succeed in the same way that we did. And that's essentially how we think about it. So our motto at Kraken has been fix money, we fix the world. Thank you, Mr. President.
Thank you very much, Greg. And if you have any questions, or if anybody else of this very distinguished, would somebody like to say something? My male models who happen to be genius, they're brilliant and they look good, right? But anybody, would you like to say something? Go ahead, please.
Just want to thank you, Mr. President, for all of your leadership. America should lead in crypto and win in markets like prediction markets. And with your leadership and your administration, you're helping America lead here and become the crypto capital of the world. So thank you very much. I just want to thank you, Mr. President, as well as Chairman Atkins and Chairman Selig for the great work that they're doing. Thanks.
Thank you. Yeah, I just want to say that what Chairman Selig and Chairman Atkins are doing and the president has enabled with his leadership is actually working. So if you look at stablecoin usage and adoption, it's increasing the usage and distribution of the US dollar at higher and higher levels than our industry has ever seen, specifically because of the Genius Act and the movement of more and more treasuries into stablecoins and therefore into more and more hands across the world. And now the tokenization of equities, thanks to Chairman Selig's and Chairman Atkins' great work and collaboration and actual work together rather than working against each other as before, is going to distribute US equities globally and increase the distribution of those. So, we power a lot of these applications and companies, so we know what the numbers actually are, and they're massively increasing because we have regulators and leadership that enables the success and distribution of these US-based assets. So there's actually a very real and tangible outcome that's really now benefiting the US and adoption of US issued assets and the US dollar. So I just want to mention that it really is working and hitting all-time highs. So thank you very much.
Sure.
Thank you.
So if you have any questions, we have a meeting next week with the AI people. The top people are coming in, so we can talk about that. But we're leading by a lot with AI. We want to keep it that way. We want to regulate, but we want to have it regulation where they can continue to lead, not regulation that's going to stifle a very important industry. I think maybe bigger than the internet, bigger than anything anyone's seen. And we're helping in that regard, especially with regard to allowing them to produce their own electricity, which everyone thought was crazy that it would never be approved. We're getting them fast 2- and 3-week approvals. They're building some of the greatest electric plants anywhere in the world because our grid is old and tired and weak. And they're actually giving the excess electricity into the grid, but they're building power plants that nobody's ever seen anything like it. We're not using the power from the grid. We're using brand new power. So it's a great thing because that misconception has been out there that we're taking electricity. We're actually creating electricity. And that's something I was proud of because that was my idea. Nobody believed it. Actually, it went along for 2-3 weeks. I said, how come these guys aren't submitting? Well, they thought that you were just kidding because that's the way it's been in this country. Nobody would ever say a thing like that. But no, they're building power plants the likes of which, all different fueled, all different ways, but the likes of which we've never seen. The people that are in the power business said we're seeing things that we've never seen before because a very high level of intelligence is doing it. So it's been great. Okay, any questions?
Mr. President.
Yeah, please.
Mr. President, does the administration have any plans to accumulate sizable amounts of Bitcoin or other crypto?
Well, it's been talked about. I think I'd probably rely on Paul and the whole group for that. He'll make a decision. You guys will make a decision, and you'll let me know. But certainly, it's been talked about. It's taken a lot of pressure off the dollar. It's been very, very good for the dollar. And I think if you came in with recommendations, two of you, if you came in with some recommendations, I would certainly listen. It seems to be a pretty big subject. Yes, please.
Hi, President Trump. I have two quick questions.
Go ahead.
Don't get around here much. So my first question is, we're talking about AI and crypto a lot.
Right.
You won overwhelmingly with working class Americans in 2024, tens of millions of working
Right.
class Americans. Many of them, they say, we love President Trump, but we're still cautious about AI and
Yeah.
crypto. What do you say to those who are still reticent to embrace this?
So I think it's a great question, and I think it's going to create a lot of jobs. It's going to create success. It's going to create tremendous innovation medically. I mean, they're coming up with already, amazingly, they came out with something today that I looked at it having to do, I won't go into the details, but having to do it with a pretty unstoppable disease. And all of a sudden they're coming up with answers that they never thought were possible and things that they never even would have thought about. So I think it's really creating jobs. And I can tell you one thing, if you look at our construction jobs right now, because we're building more plants, factories, things that really have something to do with the AI, but also car factories, car plants, they're moving into our country. Honda just announced, Toyota just announced, they're moving their operations from Mexico, from Canada, from other places. We, by the way, probably have a deal with Canada. You probably saw that. We very major tariffs were going on to Canada today. We delayed it for 3 days because I think we have a deal with the Prime Minister and good deal for everybody. So that's good. But the construction jobs are enormous. We're building the biggest plants anywhere in the world. And I can say if I were the mayor of a town or the governor of a state and I had a chance to get a big plant in, an AI plant or a data center, I would absolutely want it because the jobs are enormous and the money paid, the taxes paid are just enormous. And if you don't take it, you're going to be left behind because there are plenty of places that want it. So I would say that maybe it can use a little public relations help. But if I were a governor or mayor, I would want that plant in my community. And many of them are designed in a very beautiful way. It's really very positive. Okay, thank you.
A little off topic. So you mentioned Joe Biden and some of the past leadership, and it's been about 69 days since we've seen Mitch McConnell. Sometimes when you look at Congress, it looks like the cast of the moon. But I read a Cindy Adams column in the New York Post recently, and she talked about how we need term limits and someone needs to hold Congress accountable. Maybe you should be the person to do it. Would you support term limits for Congress or some type of cognitive testing? Because maybe if we had that the last 4 years, we wouldn't have ended up in some of these messes.
So term limits are very popular with the public. I've seen it both ways. I've seen where people go in and they get termed out and they're very talented and they're at the height of their career, you know, politicians. And you end up with total rookies in there, nothing gets done. And I've seen it the other way where people are there too long. We see that all the time. I see both. I always like to say that a term limit is an election. You know, the public's pretty smart. You see that last night. We had some great success last night. The Republican Party had tremendous success last night. But I like to say that term limits should be elections. But I'm okay with term limits. Remember, the people that have to pass term limits are the people that are going to be voting on them to get out of office. So it's a little bit tough. That's not the easiest vote to get, is it, huh? But I'm okay with it one way or the other. I do think elections really term people out.
Mr. President, I want to ask you about Canada, but first, the Treasury Secretary says that we could see the most impactful sanctions on Iran this week. When will they come, and what else could be sanctioned on Iran?
Well, we have things that we could sanction. We have very draconian sanctions, and we'll see what happens. Right now, the strait is open. A lot of boats are coming through. People aren't reporting that, and that may slow down a little bit at some point. But right now, a lot of boats are coming through. The naval blockade has been extremely effective. Zero, I mean, literally while it's up, and that's been for quite a while, you know, except for a couple of little pauses where we opened it purposely with a deal. But the deal didn't terminate, you know, the deal didn't turn out to be what they said, you know, when they tell us one thing and they do another. But the blockade has been 100% successful. No boats have gotten into Iran, but they are getting in for other places. But we'll see. We're going to see what happens. It'll either be extremely good and oil prices are going to drop like a rock, or we'll continue to do exactly what we're doing. You know, they were talking about $350 a barrel, and it's today 84, 85. And we are getting a lot of oil out. But the other thing that's happened is people have found other alternatives, which they never thought about. Texas, Alaska, Louisiana, and other places. In addition, a lot of pipelines, record numbers of pipelines are being built. So I think the Hormuz Strait's not going to be quite as important as it was in the past.
Yeah, on Canada, if I can ask you, you said that there's a deal, an agreement in place. Are you willing to lower tariffs on steel and aluminum?
Well, we're looking at that. Yeah. Well, we're getting zero for our farmers. You know, farmers have been hurt very badly by Canada, and they won't be paying any tariffs anymore. And we may bring some of the tariffs down to a level where other countries are, because Canada was paying a higher tariff. Canada was paying us a higher tariff. So we are, look, we have a very nice relationship with leadership right now, and we'll see. But we did a 3-day pause. It was supposed to be a 50% straight across the board tariff that was going into effect at 7 o'clock this morning. And I delayed it at the request of Canada for 3 days so we can iron out the details. But it's going to be a wonderful deal, hopefully a wonderful deal for everybody. Yeah.
Mr. President, earlier today you said North Korea has something like 57 nuclear weapons. They've been expanding their nuclear program. Is your goal in trying to re-engage with Chairman Kim still denuclearization? And what makes you think you could be successful now when you weren't?
Well, I don't want to talk about that, but I do have a good relationship with Kim Jong-un. As you know, you've seen. He didn't like Biden. He didn't like Obama. He didn't like anybody, but he likes me, and I just got along with him very good. We had great meetings. We speak, and I think our nation, and I think other nations, frankly, whether it's Japan or South Korea, they're a lot safer if I'm president than if somebody else is president. Now, I didn't like the fact that we're doing these massive military exercises, really against North Korea. It was an exercise against North Korea. When I'm friendly with him, when we have, I don't see anything happening for certainly 2.5 years. It's not going to happen with me, but I don't see anything happening. And I was not happy when South Korea said, no, they're not interested in helping us with the Hormuz Strait. And yet they get 60% of their oil from the Hormuz Strait. I said, would you like to help us? He said, no, thank you. I said, that's nice. Please. Thank you. He made us a lot of money. I didn't like that. So I felt that to do we were doing a massive war exercise. I thought that was very insulting to somebody that, frankly, has been, during my term at least, very well behaved. Yeah.
On the bond market, is the administration done enough to stabilize the bond market after yesterday?
Well, I think it is, but I mean, it's very sad. Every time we do great, we announce great numbers, the interest rates go up. And they go up because they want to stop inflation. They should go down because the country's strong. You know, I see countries like Switzerland where they're the #1 lowest interest rates, 0.5%, and we pay 3.5%. And yet, if we stop doing business, for instance, I have the absolute right to cut off all business with a country like Switzerland, like anything. So why are they prime if I can cut off the business and they are no longer functional? And yet they're considered to be like an elite country. And I don't want to single them out because there's 60 countries like that. They live off the United States. So why are we paying higher interest rates than them? You know, in the old days, we used to pay the lowest interest rate, no matter how we were doing, because we sort of generate for the whole world. And I want to see it where interest rate, and I have to tell you, we have a wonderful chairman. I think he's doing a great job. The problem is he has a board, and it's a political board. People put in by Obama, Biden, and me. And there are quite a few members still left, as you understand. And so they vote to raise interest rates. I don't know if they're doing it because they think they're doing a good thing or because they like the politics of it. But my point is, years ago, 25 years ago, when the country announced good numbers, interest rates went down because we had a stronger country. Now, when we announce good numbers, the better they are, the worse it is for interest rates. So we could have a GDP of 10 times. You know, they say, oh, it's going to be 3 times or 4.1. We could have a GDP of 10, 12, 15 times if they just leave us alone. Let the rates go down. We should pay the lowest interest rates. You know, every point of interest is $600 billion. Think of that. Every point of interest is $600 billion. 2 points means we make a fortune, but we keep driving it up. It's a very unfair system. And I've said it now for a long time. When our country does well, interest rates should go down. I mean, every time I hear our country's doing well, I say, oh, it's too bad, because they lift up interest rates. They should drop interest rates because it means we have a strong country. And it's all based on credit, meaning good credit. And we have the best credit. And we'd pay off the debt very easily, very quickly. But if somebody's paying a half a point, we should be paying a half a point, not somebody else. So right now, I think it's Switzerland has the lowest. Again, and I don't want to single them out, but if you take our business away from Switzerland, they have problems. So why are they paying a half a point and we're paying much more than that? Does that make sense to anybody? I mean, it seems pretty simple to me, but it's a killer. You know, I almost like to hear bad numbers. I'm saying, I hope we have bad numbers today. Interest rates, we're going to. It doesn't make sense. When our business is good, we should lower interest rates. And then you want to build America, you're going to see a building like you've never seen. We're doing great, even despite the fact of what's happening with interest rates. No, I don't think so, because like I said, our country is doing so well despite interest rates. We have interest rates that are artificial. They're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, oh, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous. Look, when our country is strong, interest rates should go down. When our country is weak, frankly, they should go up. But this country is strong. There's never been in history the kind of money coming into a country as we have right now. Trillions and trillions of dollars are being invested in plants, factories, everything. Everything you can think of. We're the hottest country in the world. We are by far, and I said it 100 times, the king of Saudi Arabia, but many people, they said 2 years ago, 3 years ago, your country was dead. Now you have the hottest country in the world. That's what we have. We have the hottest country in the world, and these people are helping us a lot. Thank you very much, everybody. Come on to the Oval Office. We're going to take them into the Oval Office. We're going to show them a real office, okay? Their offices are nice, but this is nice.
Okay. I'm glad that wrapped, because I was getting a little bit concerned that we're going to have to cut it short. I'll have more to talk about with crypto. We might even do a review of some of the crypto names as Ethereum is running, Bitcoin is running some of these companies. And, like they said, there might be some new SEC changes that also allow for new tokens to run. And like they talked about with Hyperliquid, as Trump started talking, which is the stock that is tracking Hyperliquid strategies, went up 26%. Okay, so there are some definite names that are seeing some big benefits off of that. But Moderna, oh my gosh, even after some of the comments that Trump talked about, made that stock run even further. If you guys didn't see the news this morning, this stock got a new potential drug trial for cancer, for a personalized cancer treatment. I think it was specifically for melanoma. I'd have to double check that, but into phase 3, which I think is like the great barrier for these companies to pass. And so the stock is up 170%. New market cap on this business, 67 billion. So just think about the amount of run. This was potentially a 16, 17 billion dollar company yesterday. Today, 67 billion. Or no, it would have been what, 25 billion to 67 billion? If I'm doing my math correct. Pretty wild run there. So, ladies and gentlemen, that's it from me. I'll see you guys on a Mitch show later. This is Wednesday, so we now have a show with myself, Couch Investor, Jose. Yeah. Anyway, thank you all so much for watching. See you guys at 4:15. Bye for now.